A very good morning, friends. So I hope you're all doing well. And of course, most importantly, I hope you made a revision of all the accounting procedures which are required for consolidation. Well, in the previous class, we had a detailed discussion and I made a run through of a total of 4 cases with you, giving you the inputs in terms of the 5 rules which we are going to use for consolidation. I gave you the case number 1, where we were looking at the consolidation on acquisition date. One is without NCI and one is with NCI. Then I gave you another 2 cases where we're looking at a consolidation at a late date, and that is again without NCI and with NCI. And on the basis of all the 4 cases, I had given you 5 rules. I'll not call them as principle, but there are 5 thumb rules which we need to keep in mind on consolidation. I know I've not yet documented those rules to you. I'll be doing that very soon, but I have a little more inputs to give you before we document those rules to you. But just to take a quick recap of those 5 rules of consolidation, we decided number 1, investment which the parent company has in the subsidiary company does not appear in the consolidation. Reason, it is taken in the calculation of goodwill. Number 2, the equity share capital of the subsidiary company does not appear in the consolidation. Reason, it's taken as a part of goodwill as well as the NCI calculation. Number 3, we need to be a little careful that as far as the other equity of the subsidiary is concerned, it is split in terms of pre and post acquisition. The pre-acquisition is not taken in the console. Reason, it's taken in the NCI and the goodwill calculation. But remember, the post-acquisition increase is taken in the consolidation. The parent share gets added to the other equity of the parent, and the NCI share gets added to the NCI. So basically, the post-acquisition gets split in terms of the parent share, which goes in other equity, and the NCI share, which goes in the NCI. Then we decided, number 4, that goodwill is to be computed, NCI is to be computed and reflected as a separate line item in the balance sheet of the company. And number 5, we decided that you need to aggregate all the assets and liability, except the exceptions which I gave you, in the consolidated balance sheet 100%. Irrespective, the percentage stake is 100 or it is below 100, because control can be achieved at any percentage, generally more than 50. So irrespective of the percentage, the consolidation, the aggregation of assets and liability is always done 100%. So these are the 5 rules which we had developed on the basis of the 4 cases which I gave you. Now, before I give you in detail a 6-step model, though you can call it as a 5-step model, but effectively a 6-step model. So before you make a consolidated balance sheet, there will be a certain sequential steps which we are going to follow for consolidation. But before I give you all those steps of consolidation, I have 2 adjustments which I need to discuss with you, because in most of the questions on consolidations, the 2 common adjustments which you're going to confront, one is the elimination of intercompany owings, and the other is the elimination of unrealized profits, or what we commonly call as the elimination of stock reserve. So I think let's first discuss the 2 adjustments with you. Then I'm going to give you a sequence of steps which we need to follow for consolidation, and then we'll start a journey of doing comprehensive questions with you. So let's begin the journey. I guess let me see if there is any questions to begin with. Otherwise, we'll start off. Okay, so I think so far so good. Good morning once again to all of you. So I think let's begin the journey with the adjustments. So I am coming to 2 typical adjustments. So I'm coming to the adjustment number 1. What we can say is the elimination of intercompany owings. The elimination of intercompany owings, which is pretty simple and pretty straightforward indeed. Now, just let's assume for the sake of convenience that we are making a T-shaped balance sheet. So let's take a transaction and understand this. Let's say there is a parent company H and there is a subsidiary company S, and let us say there is a sale transaction between each other. So let's consider the parent company made a credit sale, let us say for the goods, credit sale, let us say for goods which are costing, let us say 20 lakhs, and it was sold, let us say at 25 lakhs. So let's say the parent company made a credit sale of goods to the subsidiary company for goods costing 20 and at a sale value which is 25 lakhs. Now let me caution first of all, in this transaction there are two aspects. If there is a credit sale, it would create a debtor-creditor relationship between the two. So I'm going to concentrate only on that part first of all. Another aspect is that the parent company made a profit of 5 lakhs on the deal. Well, I'm not looking at the treatment of that 5 lakhs as of now. We will look at the profits elimination as well, but separately. So let's not consider the profit on sale in this transaction. Let's only consider that there is going to be a debtor-creditor relationship because of a credit sale. So imagine the balance sheet of the parent company and imagine the balance sheet of the subsidiary company. What would be technically appearing in the balance sheet of the two companies? Well, I would say if the parent company made a credit sale to the subsidiary in the balance sheet of the parent company, he would reflect the subsidiary as a debtor, and that is to the extent of 25 lakhs, the value at which the credit sale is made. Correspondingly, if we look at the balance sheet of the subsidiary company, he would reflect the parent as a creditor to the extent of 25 lakhs. So we can very easily visualize that once there is a credit sale, one of the parties would reflect a debtor and the other party would reflect a creditor. Now, once you go to make a consolidated balance sheet, you can think logically that in the consolidated balance sheet, you would have aggregated the assets of HNS. So we would have added the debtors of holding and subsidiary. And similarly, in the creditors also, we would have aggregated the parent and the subsidiary based on my rule number 5, which means we would have added the debtors of HNS and we would have added the creditors of HNS. So this 25 lakhs is appearing as a part of the creditor and this 25 lakh is also appearing as a part of the debtor. So in the same balance sheet, you would be reflecting something which is recoverable from yourself and something which is payable to yourself, because as a group company, you would be reflecting that I have to receive this from myself, from my group. I need to pay this to my group, and doesn't make logical sense. So what we do, we eliminate this intercompany, and what we're going to do from this aggregation, we reduce 25 lakhs. And from this aggregate creditors, we're going to reduce 25 lakhs. And this is called elimination of intercompany owings. I think it's as simple as it looks like, that you just need to eliminate the common debtor-creditor relationship between the two. I know now the questions would also come to the mind. Would this make a difference if this sale was made, let us say, by the subsidiary to the parent? Well, there would be no difference at all, irrespective the sale is made with the parent to the subsidiary or it is made with the subsidiary to the parent. At the end of the day, the elimination process would remain the same. So let us clarify one thing very clear. So we can say, even in this particular case, let's suppose it was a sale by subsidiary to the holding company. We can say the accounting remains the same. The accounting still remains the same. Because whether it's a debtor in the balance sheet of the parent or a debtor in the balance sheet of the subsidiary, the elimination procedure remains exactly the same. I don't think so. There would be much concern on this particular treatment. This is a fairly simple adjustment altogether. Okay. So that was adjustment number 1, elimination of intercompany owings. So this elimination will be done in the last. That is when I'm going to prepare my consolidated balance sheet. I'll look at the additional information, see if there is any intercompany owings between the two, and we'll eliminate the same. Okay. Now let's go on to the second adjustments with you. So that was adjustment number 1. And now let's have a look at the adjustment number 2. Well, the second adjustment is nothing but it's an extension of the first adjustment where I ignored that there was a profit on sale of the stock as well. So this is going to be called as the elimination of unrealized profits. The elimination of the unrealized profits, or what we sometimes commonly call it as elimination of stock reserve, because generally when a sale takes place, it is a sale of a stock. Though let me also tell you that sometimes it could be a sale of a machinery as well. So it is not necessary that the unrealized profits would only be with reference to a stock sale. It could also be with reference to, let's say, a machinery which is sold to each other. But a machinery could lead to a little more complications because once you sell a machinery, it's a depreciable item as well. I think let's not talk of the machinery right now. Let's focus that the sale is with reference to the stock itself. Okay. So let's, I think, take the same transaction. So there is parent company and there is a subsidiary, and let's consider the parent company made a credit sale to the subsidiary company for the goods which are costing 20 lakhs and it is sold, let us say, at 25 lakhs. So we're looking at the next second aspect of the transaction, that there has been a profit on sale of the goods. So the parent company made a sale of goods which were costing 20 lakhs to it and it is sold at 25 lakhs. Now watch this carefully because this could be a slightly complicated transaction. Now let's imagine the position in the parent company's balance sheet and the subsidiary company's balance sheet, and then we'll see what is the treatment to be done in the consolidated balance sheet. So this is the extract of the parent's balance sheet. This is the extract of the subsidiary's balance sheet, and this is the consolidated balance sheet. Now, in this particular case, when the parent company made a credit sale of goods to the subsidiary, he made a profit on the deal. And this profit on the deal would have been taken as a part of the profits of the parent. So we can say in the balance sheet, the other equity of the parent, or we can say in particular, the retained earnings of the parent would include this amount. So we can say the other equity of the parent company. In particular, we can say the retained earnings, because other equity is a generic term and it would include all the components of SOKI, and that would be including the other comprehensive income components as well. But typically this profit would have been a part of the retained earnings. So the parent company would have taken a profit of 5 lakhs on this as a part of the retained earnings. And the subsidiary company would reflect the stock at 25 lakhs, which is the cost to him. Though the cost overall to the group is 20, but to him, the purchase price is 25 lakhs. So he would reflect the goods at 25 lakhs in his balance sheet. Now, I know there would be another question coming in. So what happens if he sold a portion of the stock? Don't get worried. We'll discuss about that as well, that if a portion of the stock is sold, then what is to be done? For the time being, let's assume that the entire stock which is sold is unsold in the hands of the subsidiary. Now, when you make the consolidated balance sheet, you would aggregate the stock and you would add the holding and the subsidiary. You would also pick up the other equity of the parent company as a part of the consolidation. So 5 lakhs will be included out here, and this stock will be including 25 lakhs. Now, I think this would again be illogical. You're reflecting the stock at 25 lakhs in the balance sheet, and correspondingly 5 lakhs, which is again is getting reflected in the balance sheet. But you can see one thing. On a separate financials of the parent company, this gain stands realized. If you look at the separate financial statements of the parent, the gain is realized because he's going to treat subsidiary as an outsider. But even you're looking at a group financial statements, this profit cannot be said to be realized because you're selling this stock to your own company itself, your own group company itself. So in this particular case, inflating the stock by 5 lakhs and reflecting this profit of 5 lakhs as realized would not make sense. So to the extent, mind the words, to the extent the goods are unsold, the profit is unrealized in nature. So what we need to do in the consolidated balance sheet, we should eliminate from this aggregation of stock 5 lakhs. So that the stock comes down at 20, and this profit which is unrealized also gets eliminated from the other equity. So pretty simple and straight indeed. Which means what we have done, we've eliminated this unrealized profits both from the stock as well as the other equity of the parent company. Now, another question what comes to the mind is, let's assume that out of this stock, let us say 50% of the goods are sold, and let us say 50% of the goods are still unsold. So let us say the parent company made a sale to the subsidiary company, and half of the goods have been further sold to an outsider, and let's say the remaining goods are still unsold. Now the question arises, the elimination of the unrealized profit should be how much? Naturally, the unrealized profits will be eliminated to the extent of unsold goods only. So we will eliminate in this case only 2.5 lakhs, both from the stock as well as the retained earning. So the only thing which you need to be cautious on is the unrealized profits will be eliminated to the extent of the goods unsold. So let's put this across. So stock reserve will be eliminated. The stock reserve will be eliminated. And the rule is it is eliminated to the extent. So to the extent of unsold goods only. Underline the word unsold goods. So the elimination of the unrealized profits will be done only to the extent the goods are unsold. Does this mean that if the entire goods have been further sold to the outsider, there is no unrealized profits to be eliminated? Of course not. And now another question what comes to the mind. Previous adjustments, I said that this was a sale whether with the parent to the subsidiary or subsidiary to the parent, the procedure remains the same. But in this particular adjustments, if the sale is made by the subsidiary to the parent, the treatment would not remain the same. So I think let's give you another caution as well. So we can now say that if I'm looking at the adjustment number 2, in a little more detail, I would say before you treat the adjustment number 2, be a little cautious on who made the sale. So there is a concept which is called downstream. There is a concept which is called downstream transaction, and there is a concept which is called upstream transaction. And as the word is indicative, so is the accounting. When I say it is downstream, it is a sale by parent to subsidiary. It flows down. And when I say upstream, it is a sale by the subsidiary to the parent. So at the first instance, what you need to look into the question is it upstream or is it downstream in nature? So how do you decide a down and an upstream transaction? You need to see the flow. So if the sale is made by the holding to subsidiary, it is flowing down. And if the sale is made by the subsidiary to the parent, it is going to be upstream. The accounting treatment is not going to be similar if it is a downstream or if it is an upstream transaction. So let's do one thing. We have quickly seen the inputs in terms of downstream, but just to give you a little comparative position. So just to give you a comparative position, let's consider the downstream as well as the upstream on a comparative basis. So let's consider this is the balance sheet of the parent, and this is the balance sheet of the subsidiary. This is the consolidated balance sheet. So we'll see the run through in terms of both transactions, upstream as well as downstream in nature. Well, the previous example which I gave you was a case of a downstream, so I think you already know. So in this particular case, the stock was appearing at 25 lakhs. And the other equity, that is retained earnings, is appearing to the extent of 5 lakhs in the separate and standalone financial statements. And we decided that this profit is something which is unrealized. So what do we need to do in the consolidated balance sheet? From the figure of stock, when you've aggregated holding and subsidiary, you need to reduce that 5 lakhs. And when you've taken the other equity retained earnings of the parent company, you got to reduce that 5 lakhs. So this is what we've already seen. Now, let's focus on a upstream transaction. Now, be careful as I give you the analysis, because I'm going to slightly change how I'm going to deal with an upstream transaction a little later. So in this particular case, since the subsidiary made a sale, this amount of profit is a part of the retained earnings of the subsidiary. Because the subsidiary made a sale to the parent, so it is an upstream transaction. So this profit is made by the subsidiary company. Correspondingly, the parent company would include the stock at 25 lakhs in the balance sheet. Now, hear this carefully. When we would have made a consolidated balance sheet, remember my discussion in the previous class with you. This other equity of the subsidiary is analyzed in terms of the pre and the post acquisition. Be careful. This other equity which is appearing in the subsidiary's balance sheet would have been split in terms of pre and post acquisition. If you remember the case number 4 which I gave you, in that particular case, we had split the profits in terms of that this is what is on the acquisition date and this is the increase which is earned in the post acquisition period. So we would have analyzed this other equity in terms of pre and post acquisition. That's one. Now, first of all, I am presuming that this transaction took place in a post-acquisition period, unless mentioned otherwise. Unless mentioned otherwise, I will always assume, I'm saying unless mentioned otherwise in the question, I will always assume that this sale took place in the post-acquisition period. Not that it cannot take place in a pre-acquisition period. So I will always assume that the sale of stock took place after the control has arisen. So the sale was taken place in a post-acquisition period, which means that this profit of 5 lakhs is a part of this post-acquisition earning. Because if the sale took place in a post-acquisition period, this entire profit of 5 lakhs is a part of the post-acquisition earnings. And the post-acquisition earnings is split between the holding and the NCI. If you remember the case number 4, which we did last time, the post-acquisition earnings is split between the parent share, which is added to the other equity in the balance sheet, and the NCI share, which is added to the NCI. So in this particular case, let's assume a percentage. So let's say 80% belongs to the parent, and let's say 20% belongs to the NCI. So out of this 5 lakhs, you can say 80%, that is 4 lakh, would have been taken as a part of the other equity in the balance sheet. And that 20%, that is 1 lakh, would have been taken in the NCI. I think, let me put this once again. When you consider the other equity of the subsidiary is first split in terms of pre and post. Unless I am given anything to the contrary, I would safely assume that this entire transaction took place in a post-acquisition period. So this 5 lakhs is a part of the post-acquisition earnings, which is ultimately divided between the parent and the NCI. The parent share, that is 4 lakhs, would have been taken as a part of the other equity in the balance sheet. You would have added this 4 lakhs as a part of the other equity in the balance sheet, and the 20% would have been taken to the NCI. So what we're going to do in terms of the consolidated balance sheet is we will eliminate 80%, that is 4 lakhs, from the retained earnings. We will eliminate 20% from the NCI, and from the stock, you're going to eliminate 5 lakhs itself. So the elimination out of the stock remains the same. The elimination from the stock is 5 lakhs, irrespective it is a downstream or it is an upstream transaction. But we need to be careful that if it is a downstream transaction, the entire profit is getting eliminated from other equity. But if it is an upstream transaction, the parent share is getting eliminated from the other equity and the NCI share is getting eliminated from the NCI. I hope I'm making sense. So, moral of the story. When you're going to look at a sale transaction, the intercompany owings doesn't make a difference who made a sale. The concept of upstream and downstream transaction is irrelevant when you go to eliminate the intercompany elimination. But when you go to eliminate the unrealized profits, we need to be careful and we need to decide if it is downstream holding to subsidiary down or it is upstream subsidiary to holding that is upstream. If it is a downstream, your elimination will be from the stock and the other equity of the parent company. But if it is supposed to be an upstream transaction, you need to split the profits in terms of the parent share, which gets eliminated from the other equity, and the NCI share, which gets eliminated from the NCI. The elimination of stock remains the same. I hope, friends, I am pretty much clear on the two adjustments, intercompany eliminations and the unrealized profits. Let me still see if there are any questions coming in. Okay, Uday, sir, you gave me another way to see the transaction. Thank you. That's wonderful indeed. Thanks, Uday. Okay. So now with these two things in hand, let's make now a run through of the steps with which we are going to solve a question on consolidation. Don't worry, we're going to do a lot of practice. We're going to do questions from simple to complex ones so that we get a complete hang in terms of consolidation. So now let me start the journey in terms of the steps. In terms of the steps which are required to prepare a consolidated balance sheet. The focus right now is on the balance sheet. We'll come to the focus on consolidated income statement later. Now, my advice is when you're doing a question on a consolidated balance sheet, please go on a step-by-step basis because there are certain things which we need to apply in a sequence so that at least we go wrong. So what we're going to do, I have created a total of 6 steps which we are going to follow. So now logically, let me explain those steps. But all these steps which I'm giving you is based on my discussions in the previous class when I gave you a total of 4 cases. So correlate what I'm going to give you in terms of the 4 cases we have done. Well, the step number 1 is very simple and straight indeed. So what we're going to do in step number 1, you are going to identify the date of acquisition, and you're going to identify the percentage of holding. So this is something which is very straightforward indeed. You just need to read the question and you're just going to identify the date of acquisition. Now, why the date of acquisition is important? Because that would decide what is pre-acquisition and what is post-acquisition. So identifying the date of acquisition is important. So how do we look at the date of acquisition? Trust me, it is based on the concept of Ind AS 103, which we have already done, though you can see that it will be directly given in the question. Once you're going to get a question on consolidated balance sheet, not Ind AS 103, getting the acquisition date is going to be a very straightforward exercise, though the concept of identifying this is based on Ind AS 103. And as far as the percentage is concerned, that would also be very apparently given in the question. Now let's go to the step number 2. Now, I need to give you a logic as well because every step has got its own logic. So hear me very carefully as I go through all the 6-step model in terms of consolidation. Now, if you remember the discussion which we did in the previous cases last time, there could be a case number 1 or 2 where you're making a consolidated balance sheet on the date of acquisition itself, where you're making the consolidated balance sheet on the date of acquisition itself with without NCI. Or we can say there is going to be a case number 3 and 4 where you're going to make a consolidated balance sheet at a later date. So here you're going to make a consolidated balance sheet at a later date. Now, watch this carefully. So once you've seen after reading the question whether it is a case 1, 2 or whether it is a case 3, 4, now you need to be careful. I need basically a calculation of goodwill. Please mind the words carefully. I need the calculation of the goodwill where I need the net assets on the date of acquisition. Once I'm going to calculate the goodwill as per Ind AS 103, you need to consider PC plus the NCI, and you need to compare this with the net assets on the date of acquisition. Now, let me first give you some logic. Even if you remember in the last class what I gave you, if you look at a balance sheet of a company, you've got non-current assets, you've got current assets, current liabilities, equity share capital, as well as other equity. Now, I gave it to you in the previous class clearly that either you consider this as the net assets, or what we also call the equity, or you can consider this as a net assets, or you can call it as equity. So when you say net assets, one possible way is that you consider assets minus liability, or the other possible way is you take the sum total of the equity share capital and the other equity. Now, please hear this carefully. I'm giving you a logic now. If you're in case number 1 and 2, where the consolidation is done on the acquisition date itself, in that particular case, the balance sheet of the subsidiary is on the acquisition date. And if the balance sheet of the subsidiary is on the acquisition date, you can simply use this technique to calculate the net assets. You can simply consider this technique, or alternatively, you can simply consider the sum total of these as well. But if you come to the case number 3 and 4, the problem is that we need a consolidation at a later date. So the balance sheet of the subsidiaries would also be given not on the acquisition date, but at a later date. So I would say the best way to do this particular calculation is you consider this total as the equity, because the examiner will give you the status of the pre-acquisition profits. So calculating the net assets on the date of acquisition would be easier if you consider the total of the share capital plus the pre-acquisition profits. It's a moral of the story. I would suggest when you want to calculate the net assets on the date of acquisition, I think this is the better way out. Instead of making a list of assets minus liability on the date of acquisition, it is better that you consider the sum total of the equity share capital plus the pre-acquisition profits. Because when I'm looking at the net assets on the date of acquisition, we need the other equity on date of acquisition. So in this particular case, what I'm going to do, if you are given case 1 and 2, I will simply add the equity share capital and I will add the other equity which is given in the question, and this will give me the net assets at the date of acquisition. So I will simply add the share capital which is given on the date of acquisition itself and the other equity of the subsidiary on the date of acquisition itself. I will directly get what is the net assets on date of acquisition. So this will directly give me the net assets at the date of acquisition. But in the case number 3 and 4, if the acquisition was earlier and the consolidation is taking place later, now what do you need to do in step number 2? You will split the step number 2 in 2 parts, step number 2A and step number 2B. In terms of the step number 2A, what I will do analysis of other equity. How we are going to do the analysis of other equity, I'll explain in a practical question to you. I will make the analysis of the other equity of the subsidiary company and split this equity in terms of what is pre and what is post acquisition. If you remember in case number 4, we just did it directly because I gave you a direct information. This is the equity on date of acquisition and this is post. But in a normal full-fledged question, you will first do the analysis of the other equity, dividing the other equity in terms of pre-acquisition and post-acquisition. How do you do the analysis? Don't get worried. I'll explain in a comprehensive question. Then I'll go to the step number 2B. I will add the equity share capital and the other equity that is pre-acquisition computed in step 2A. You would have already calculated the pre-acquisition equity, which I will add to the share capital, and this will give me the net assets on the date of acquisition. I think let me put this once again. So I would say when you are in step number 2, since we need the net assets on date of acquisition, the objective is very clear. For goodwill, we need the net assets on acquisition date. So what I need to do, look at the category of the question. Is it a question where we need a balance sheet on acquisition date itself? The subsidiary's balance sheet is given on the acquisition date itself. So getting the net assets is not a problem. Just add the share capital and the other equity because that is on the acquisition date itself. There is no post-acquisition period. So we don't need an analysis. So in this case, just add up the share capital and the other equity. You directly get the net assets. Analysis is not required. Analysis will not be required in terms of case number 1 and 2, where the consolidation is on acquisition date itself. Next, when you're looking at a case 3 and 4, where consolidation is done at a later date, you need to first get the analysis of other equity, split the profits in terms of pre and post. How? We'll see later. And then you take the sum total of the share capital of the subsidiary and the pre-acquisition profits, and you get the net assets on date of acquisition. I hope, friends, I am pretty much clear in terms of the step number 2. Okay, Uday, you said, so we do these in AS21 just like that. Yes, you're right. And why not capital reserve? Well, if you're trying to recall what you did in Accounting Standard 21, in IGAAP, the balance sheet reflects a reserve and surplus. But in terms of the Ind AS, what reflects in the balance sheet is other equity, which is a combination of reserve and surplus as well as other comprehensive income. Because if you recall, the concept of other equity is nothing but what is appearing in SOCI, where you got a tab number 1 in terms of the compound financial instruments equity component, the tab number 2, which is a reserve and surplus, and the tab number 3, which is OCI. Well, of course, in a consolidation questions, you're not going to see the compound financial instruments, though you're still yet to learn on that. So you're going to see only tab 2 and 3. So when I say analysis of other equity, I'm looking at the analysis of the entire tab number 2, which is reserve and surplus, security premium, capital reserve, retained earnings, and also the tab number 3, which is other comprehensive income as well. Right? So don't get worried on that. We'll be coming to that very soon. So this is the step number 2. Further, then I go to the step number 3. You need to go on a sequential order. And how we're going to apply the step number 2, don't get worried. Once we come to the practical illustrations, I'll explain in detail. Now, once you come to the step number 3, what I need to do in step number 3, you need to calculate the NCI. Now, careful. Now, since we are making a consolidated balance sheet, in this particular case, we need NCI on the balance sheet date, not on the acquisition date. So in this particular case, what we will do, we will consider the NCI as per Ind AS 103. We're going to calculate the NCI as per Ind AS 103 on date of acquisition. So we need to first of all calculate the NCI based on Ind AS 103, which you have already done on the date of acquisition. And if you recall, Ind AS 103 gives you a choice in terms of calculating the NCI either at a fair value or at PASNA, proportionate share in the net assets of the company. Now, we are calculating NCI with which approach will be clearly stated in the question. So sometimes it may not be clearly stated, but I think if you're not given a fair value, if You're not given a fair value. PASNA becomes, you can say, by default choice. So either the question will very clearly tell you that we're taking NCI at PASNA or fair value, but if nothing is stated clearly, just read the question. C is the fair value of the shares given. If the fair value of the shares is not given, then I think PASNA becomes a default. So you're going to calculate the NCI based on the date of acquisition, and to this we will add the share of NCI in post-acquisition profits. The share of NCI in the post-acquisition profits. Remember the case number 4, where in my question I'd given you the profits during the post-acquisition period was 30, and out of that 20%, that is 6 was added to the NCI. So we're doing a formal presentation of the calculations. So the NCI on the date of acquisition, to this we're going to add the share in the post-acquisition. And this information is going to be available from the step number 2. Once you've done the step number 2A, that is analysis of the other equity, it'll tell you what is the pre and the post-acquisition profits, and you'll be able to calculate the share of the NCI in the post-acquisition profits. Then we come to the step number 4. Then we're going to come to the step number 4. And in terms of the step number 4, you need to calculate a goodwill or a bargain purchase gain. That's what we technically call a capital reserve. Now, in this particular case, trust me, everything is going to be absolutely similar, but I'm just going to add a small little inputs at this stage. Be careful. So as far as goodwill or bargain purchase is concerned, it is going to be 100% same as Ind AS 103. So it's going to be same as Ind AS 103. So whatever you have done in terms of Ind AS 103, the goodwill or the bargain purchase gain is going to be computed exactly the same way, which means you're going to consider the purchase consideration, add the NCI, and then compare it with the net assets on the date of acquisition. And trust me, in this particular case, you can see the purchase consideration would be directly given in the question. The PC would be given in the question, because this would be investment in the parent's balance sheet. The purchase consideration is nothing, but it is supposed to be the investment appearing in the balance sheet of the parent company. The NCI you've already computed in step number 3. And as far as the net assets on the date of acquisition is concerned, you've already computed in step number 2B. So it's going to be simply organizing the data where you will add the PC and NCI and compare it with the net assets on the date of acquisition, and you're going to get the goodwill or bargain purchase gain. Now, a slight little technical issue to give you. Sometimes the examiner would also give you a goodwill impairment in terms of a consolidation question. Now here you need to recall what you did in Ind AS 103 when I gave you some inputs. The moment your NCI is taken at a fair value, we get the concept of what we call a full goodwill, which I gave you in Ind AS 103. And the moment you take the NCI at PASNA, we will get the concept of what we call a partial goodwill. I had already taken an example and I had proved this in Ind AS 103 that when you consider NCI at PASNA, you get a partial goodwill. And if you're going to get NCI at a fair value, you're going to get a full goodwill. Full goodwill means this goodwill is belonging to both parent and NCI. Partial goodwill means that this goodwill is belonging only to the parent company. So we need to be careful if the examiner gives you any goodwill impairment, though we'll deal with this in a question. If the examiner gives you an impairment of goodwill, if I am given in the additional information that there is any impairment of goodwill, please be careful. If the goodwill is full goodwill, impairment will be divided between the parent and NCI both. The impairment will be segregated and you'll take a hit to the parent and the NCI. But if it is a partial goodwill, then the goodwill impairment will be borne only by the parent company. How do we tackle that? Don't worry, we'll see later. So, but we need to be careful that if I am given the impairment of goodwill and you've taken the NCI at a fair value, which means it is supposed to be a full goodwill, then the impairment loss is borne. The impairment loss is borne by the holding and the NCI both. Because the full goodwill is appearing in the balance sheet, so impairment is going to be borne by the NCI and the parent company both. And if your NCI is taken at PASNA, in this particular case, you've got a partial goodwill, then this impairment loss is borne only by the parent company. Because NCI's goodwill is not appearing in the balance sheet, so this goodwill impairment is borne only by the parent. So it is borne by parent only. It is borne by the holding company only. Now, how do we tackle all this? Don't worry, we'll see in a practical illustrations later. But just keep in mind that there could be a goodwill impairment given. And if there is a goodwill impairment, we need to be careful. Is it a full goodwill? Is it a partial goodwill? Accordingly, the impairment hit is taken by the parent, NCI both, or just the parent company. Okay. So this was step number 3 as well as the step number 4. Then comes the step number 5, which is very crucial indeed. And sometimes we forget to consider that. And Uday, you said, so can we call this as a minority interest? Well, in IGAP, we used to call it as MI, that is minority interest. But in terms of Ind AS, we use the concept NCI. Yes, NCI and MI are similar concept, but we don't use the word minority interest. We preferably call it as NCI. Okay. Now let's go to the next step, and that is the step number 5. So the next step is going to be a step number 5, which many people don't do. And I would insist and I would request that please get into the habit of doing a step number 5. Because before you make a consolidated balance sheet, your step number 5 is going to give you a very crucial information. This is preparing the other equity which would appear in the consolidated balance sheet. So when you're going to make a consolidated balance sheet, you need the information in terms of other equity. So what is this other equity? If you remember the case 4, you will take holding company's own other equity. And to this, what you need to do, you need to add the share of holding in subsidiary post-acquisition profits. If you remember in terms of the case number 4, or in terms of the case number 3, when we made a consolidated balance sheet, we took holding company's own other equity, 1, and to this we added the share of holding in subsidiary post-acquisition profits. And where do you get this information? You're going to get this information from step number 2A, where you've done the analysis. Where you split the profits in pre and post, you will know what is the post-acquisition profits and what belongs to the parent company. There could be more adjustments which could take place in terms of the step number 5. But I think as of now, I've just given you one adjustment, and that is adding the share in post-acquisition profits. Now, I would definitely advise something. I did the adjustment number 2, that is downstream and upstream transaction. And my advice is that if there is going to be, let us say, a downstream transaction. Now, please hear this carefully, though I'll be able to explain this more when I come to the practical illustrations with you. But my advice is that if you are given a downstream transaction or you're given an upstream transaction, earlier, I explained that in a downstream transaction, what do you need to do? You need to reduce the stock and you need to reduce the other equity, correct? If you recall the downstream transaction, we made a reduction in stock in the balance sheet and we made a reduction in the other equity. So I would say in terms of a downstream, what do you need to do? Number 1, you take care of the reduction in profits in step number 5. You take care of the reduction in step number 5. So when you go to consider this, also reduce the stock reserve relating to downstream transaction. So at this stage, you can make a reduction of the unrealized profits because you need to reduce the unrealized profits out of other equity. So do that in step number 5. So if there is a downstream transaction, you need to make a reduction in terms of step 5. And when you're going to make a consolidated balance sheet in terms of step number 6, you can reduce stock. So in step number 5, you reduce the stock reserve. And in terms of step number 6, when I'm going to tell you to make a consolidated balance sheet, you can reduce the stock figure. So the double effect is going to be taken like this, that the unrealized profit gets reduced. The unrealized profit gets reduced from step number 5, and the unrealized profit gets reduced from the stock in terms of step 6. So when you give it a downstream transaction, you need to consider adjustments in step 5, eliminating the profits from other equity, and step number 6, eliminating the profits from stock. Now, if it is upstream transaction, in this particular case, my advice is you will not adjust the step number 5. You will not adjust the step number 5 because in this case, this profit is made by the subsidiary company. So I would advise you should make your changes in step number 2A. When you do the analysis of equity, when you do the analysis of other equity, what you should do in the analysis of other equity, you eliminate the unrealized profits. We are making the analysis of the profits of the subsidiary. So do one thing, when you do step number 2A, that is analysis of the other equity. From there, you reduce the stock reserve from post-acquisition column. Reduce it from the post-acquisition profits. Because the profits of the subsidiary is including that unrealized profits. So when you do the analysis, eliminate that profit from that stage itself. So do that in terms of the step number 2A. Automatically, everything will get taken care. Once you eliminate that profits, the NCI will also automatically get adjusted. So do this treatment number 1. And in terms of the step number 2, in terms of the step number 6, that is when you're going to make a consolidated balance sheet, you reduce the stock as well. So I've given you a slightly different treatment. I did a discussion, but since we are organizing the steps, let me make it clear. You need to eliminate the stock, the unrealized profits from the stock. So you need to be careful when you go to the step number 6 and make a consolidated balance sheet. Remember to eliminate that unrealized earning. And if it is downstream, eliminate the profits from step 5. If it is upstream, eliminate the profits from step number 2A. Your mind needs to be very sharp in terms of which step you're going to make some adjustments. Because it is upstream, the profits is a part of the profits of the subsidiary. So you need to eliminate this from the subsidiary's earning analysis. But in this case, it is downstream. It is a part of the parent company's profit. So you need to eliminate this in terms of step 5. I hope I am making complete sense. I know I'm running these steps without doing questions, but at this stage, I need to first give you the steps before we start solving questions. So I would say there are basically 2 adjustments you need to take care in terms of the step number 5. So when you do the step number 5, remember, you need to consider adding the post-acquisition earnings from step 2A and eliminating the stock reserve only downstream, which will be given in the additional information in the question. I'll be coming back to these steps once again, once we've started doing questions, to give you a more refinement in terms of the focus points in each of these steps. For the time being, I've just given you some basic inputs of what is done at each step. Finally, we go to the step number 6. And in terms of step number 6, it's time to make a consolidated balance sheet. And when you're going to make a consolidated balance sheet, I have already given you the 5 set of rules which you need to keep in mind. So in this particular case, I have given you the 5 set of rules which we need to consider in mind. So let's see what are the 5 rules we need to apply when you are going to make a consolidated balance sheet. So these are the 5 rules which we'll keep into account when we make a console. So number 1, you need to consider the investment which the parent company has in the subsidiary will not appear in the consolidated balance sheet. Logic I've already given. The investment which the parent has in the subsidiary would not appear in the console, gone in the goodwill calculations. Next, we can say the equity share capital of the subsidiary company would not appear in the console. So whatever is the equity share capital of the subsidiary would never appear in the console. It's gone in the goodwill and the NCI calculations. Number 3, when you consider the other equity of the subsidiary company, this is pre and post. You've already divided in terms of pre and post. The pre does not appear in the console, goes in the goodwill as well as the NCI calculations. But as far as the post is concerned, it definitely appears in the console. So this definitely appears in the console, and you've already seen that this appears, the holding share gets added to the other equity and the NCI share gets added to the NCI. So in this particular case, the post-acquisition earnings split between parent NCI, parent goes in other equity and NCI goes otherwise. So this other equity is a part of the step number 5 and the NCI is a part of the step number 3. So automatically I've inserted them out there. Then we go to the next rule, what we need to keep in mind, and that is we need to consider goodwill and NCI as separate items. So they would appear as separate items in the consolidated balance sheet. You would have calculated them in step number 3 and 4. And the goodwill NCI computed in step 3 and 4 is going to appear as separate items already computed in step 3 as well as step number 4. And finally, what do you need to do? You need to aggregate all the assets and liability. You need to aggregate all the assets as well as the liabilities, irrespective of the percentage. Irrespective NCI is there or not. Irrespective NCI is there or the NCI is not there. So we will aggregate all the assets and liability at a full value, irrespective NCI is present or not. Okay, so that was quite a massive discussion. I think let me just quickly consolidate the learnings before we apply this to practical illustrations with you. So let me just have a little focus point once again and consolidate all the inputs back to you. Okay, we're getting a couple of questions right now. Okay, Suraj, you said, sir, but still, MI used to be shown under liability side. Here, NCI is an asset. No. NCI is not an asset. If you remember the previous class, all the cases I've been reflecting NCI on the liability side. It was not on the asset side. After aggregating all the assets and liability, if you remember, below the other equity, I was reflecting the NCI in the consolidated balance sheet. It's still a liability. Okay, and Uday, you said, sir, then what is the difference between Ind AS 103 and Ind AS 110? I like that question, and I would love to answer that question right away. I'll just answer that. And Tanisha, you said, sir, could you please tell me what is been written after other equity, consolidated balance sheet to the down? What is written after other equity? Other equity of subsidiary, pre would not appear in the balance sheet and the post appears in the balance sheet, split between the holding and the NCI. Okay, now I think coming to that wonderful question what Uday has got. I'm now going to answer the question what Uday asked me, and this will either give you a clarity or will damage your concepts as well. Are you ready to take a risk? Sometimes more study is more problem, no study is no problem. So what do you want me to do? More study, more problem. Because I believe, if you do a lot of analysis, it can create problems as well. So shall I give you the connect in terms of India's 103, what you've been doing out there and what you're doing in terms of India's 110? So do give me your inputs. First, let me consolidate this learning. Then I can answer that question if you're willing to take a risk. Then we'll start with the practical illustrations on this. So let's first do a consolidation of the steps I have given you. Now, remember, when you are going to do a question on consolidated balance sheet, you've got a total 6 steps. So I would say that go on a sequential order. And if you're going on a sequential order, you always have a focus in terms of what is done at each step. And the chances of going wrong, becomes quite less. So what are you going to do in the 6-step model is number 1. You need to just read the question, get the percentage and the rate of acquisition, which is going to be a very simple exercise. Your date of acquisition would decide, in this particular case, what is pre and post. Your percentage would decide what is the percentage of the parent and the NCI. So just read and you get the information direct. Step number 2. Now you just need to remember for the time being that there will be 2 blocks of question. Either we get a question where a consolidation is done on date of acquisition itself, that you read the question and you will easily come to know that are we doing a consolidation on the acquisition date or at a later date. If the consolidation is on the acquisition date, trust me, I don't need any analysis of equity. I will simply add the equity share capital of the subsidiary, add the other equity of the subsidiary, and you will get the net assets on the date of acquisition. It's going to be as simple as that. But if you're given a question where the consolidation is done at a later date, in those particular cases, we will divide the step number 2 in 2 parts. First, you need to do the analysis of other equity, splitting the other equity in terms of what is pre and what is post. So how do we do this analysis? We'll see in the question, but the objective is segregating the profits, the other equity in terms of pre and post. And then step number 2B, where you will add the share capital of the subsidiary and the pre-acquisition, what you got in step 2A, and you're going to get the net assets. So 2 steps if the consolidation is taking place at a later date. Then in terms of the step number 3, you need the NCI on acquisition date based on Index 103. And then you need to consider add the share in the post-acquisition earnings, which you would have got in terms of the analysis of equity, step number 2A. And then you've got to calculate in step number 4, goodwill, exactly in the same way what you did in Index 103. The only caution is goodwill impairment, which we will tackle later, but I've just given at the back of your mind that if the NCI is at fair value, it's a full goodwill. And if the NCI is at PASNA, it's a partial goodwill. And accordingly, the goodwill impairment is borne by the parent or by parent NCI, both. That needs to be watched out. Then in terms of the step number 5, you need to organize the other equity in the consolidated balance sheet. When you organize the other equity in the consolidated balance sheet, you need to consider 2 adjustments. 1, the parent company share in the subsidiary post-acquisition earnings, which will be available in step 2A analysis, and elimination of the stock reserve only if it is downstream. And at this stage, I gave you how will you tackle the stock reserve in downstream, upstream. If it is downstream, take care of the profit elimination in step 5 and take care of the stock elimination profit in step 6. If it is upstream, take care of the elimination in terms of analysis of equity, step 2A, and the elimination of the profit from stock in step 6. So you need to be watchful, step 2 and 6 or step 5 and 6, depending it is downstream, upstream in nature. And then finally, I gave you the 5 golden rules in terms of making a consolidated balance sheet, which I've already briefed you at large in terms of the previous class. No investments to be taken, share capital of the subsidiary not taken, pre-acquisition equity not taken, but post-acquisition is taken, split in parent NCI, and then goodwill NCI separate line items and aggregation of all assets liability 100% irrespective of the percentage. Right, friends, so far so good. That's the consolidation. And okay, I got one input. Yes, sir. So only one person wants the input in terms of the connect of 103 and 110. I thought if more people wanted it, I would have given it. Let's keep it pending. Okay, no worry. I think since Uday also asked me, Tanisha has also asked me, let's give you the connect on that as well. Now, hear me carefully. Let's understand what you are doing in terms of Ind AS 103 and what you're doing in terms of Ind AS 110. Watch this carefully. A very important understanding which you will get at this stage. So please hear this very carefully. Either you get the inputs or you don't get the inputs. 99% you will definitely get your answer. Now, let's see what you were doing under 103 and what you're doing under Ind AS 110 and what is the connect. So this is what we were doing in terms of Ind AS 103. Now, let's consider this is the balance sheet of the parent company, and this is the acquisition entry, and this is the consolidated balance sheet. Please watch this very carefully. You will definitely get your answer of what you're asking. So this is the balance sheet of the parent company, and this is the acquisition entry which you're passing as per Ind AS 103. And then there is a consolidated balance sheet on date of acquisition. And if you look at what you're doing in Ind AS 110, this is the balance sheet of the parent, this is the balance sheet of the subsidiary, and you're making the consolidated balance sheet either on the date of acquisition or at a later date, whatever is the requirement. Now, let me give you the insight. Let's concentrate in terms of Ind AS 103. If you ask me, technically speaking, this balance sheet of the parent company is as per Ind AS 27. This balance sheet of the parent company is appearing as per Ind AS 27. So when a parent company made an investment in an investee company that is a subsidiary in the separate financial statements, he would have done the entry investment account debit and whatever shares or cash is given. So this is the investment which appears in its standalone, what we technically call a separate financial statements. So this is what is the investment in the separate financials of the parent company. Now, what we do in terms of 103, we did an acquisition entry. We said, let's put the entry assets debit, liabilities are given a credit, and the purchase consideration is nothing but it is the investment. The purchase consideration is nothing but it is supposed to be the investments, and there is an NCI, and you get the balancing figure, let's say as a goodwill. So you get a balancing figure which is supposed to be, let's say, goodwill. This is the acquisition entry as per Ind AS 103. Now, if you remember, when I did questions on making a consolidated balance sheet immediately after acquisition, because we did this acquisition entry and then we made the consolidated balance sheet. Now see what you're doing. If you incorporate this entry as a part of this balance sheet, mind the words carefully, if you incorporate this entry as a part of this, can I say the investments will get eliminated? Because what you're doing, you're giving a credit to the investment in the acquisition entry. And now see, is the investment getting replaced by? Is the investment getting replaced by the net assets, the NCI, and the goodwill? So are you reflecting the share in the net assets? You're reflecting the share in the net assets plus the goodwill. Is the investment getting replaced by this? This is assets, liability, net assets, NCI, so that you get a share in the net assets and the goodwill. So basically what you're doing in terms of Ind AS 103, to the separate financials of the parent company, you replace the investment insert the acquisition entry on the date of acquisition, and you get a consolidated balance sheet on the date of acquisition only. So Ind AS 103 gives you that acquisition entry, which incorporated in the separate financial statements will give you a consolidated financial statements on the date of acquisition itself. That was the role of 103. But this 103 is going to be applicable once in a lifetime, and that is on the date of acquisition, and it'll give you a consolidation on acquisition date only. And if you remember, the procedures which you're applying for this balance sheet is nothing but 110 based. So though for logical understanding, this acquisition entry inserted gives you a consolidated balance sheet on acquisition date. Now, when you come to Ind AS 110, what we are doing in this particular case, we're not looking at, the concept of acquisition entry. We are directly saying, let me aggregate the assets and let me aggregate the assets. Let me aggregate the liabilities and aggregate the liabilities of the parent and subsidiary. But at the end of the day, you can say what we're doing, we are basically trying to derive the same balance sheet with the calculations done under 103. So we are not going through this entry as such, but we are going through the 5 steps which I gave you for consolidation. And what are you doing in terms of those 5 steps? You're organizing the data for Goodwill, you're organizing the data for NCI, and you are trying to get the balance sheet in this case. And this balance sheet can be prepared on the date of acquisition or at a later date. Because consolidation is not a one-time exercise, but it is going to be a continuous exercise indeed. So you can say once the consolidation on acquisition date is done, 103 goes out of the picture. So you can see, technically speaking, what we need to do, this consolidated balance sheet is to be upgraded. This consolidated balance sheet is to be upgraded in terms of the balance sheet which is prepared later. So, if in a practical life you're going to see the consolidation process, it is very interesting because you make an Excel sheet and you make an Excel sheet where you show the parent company's column, the subsidiaries company column, the adjustments column, the eliminations column, and you get a total column. So that's how the consolidation is done. Because right now you're going to do it in a little more mechanical manner in terms of steps and steps. But when you're going to go to the practical life and you're going to put this all on an Excel sheet, you'll see that the consolidation becomes very interesting. So what we do in a practical life is we put consolidation adjustment entry. You have the balance sheet of the parent and the subsidiary, and then you'll put those consolidation adjustment entries, and then you get the final picture in the form of consolidation. We don't do this in terms of step 1, 2, 3, 4, 5, 6. It is basically consolidation entry. So technically, if you ask me from a practical point of view, if I'm looking at Ind AS 110, I would say that one needs to understand the consolidation entries which you need to do. But from the examination point of view, you're not going to confront the consolidation entries in this case. So you can say the consolidation entries becomes the focus in a practical life. I hope that answers your question. So depending upon the requirements in the question, you are only going to do it that way. Okay, I guess Mansha tells me, so Ind AS 103 only once and 110 every year. That's right. And Tanisha, does this mean that Ind AS 103? Does this mean that Ind AS 103? I think that was a little incomplete question. You need to put something more on that. Okay, but I hope you've got the connect in terms of the standard. So depending upon the requirement in the question, whether he's asking me to do an acquisition entry and then make a consolidation, that would be acquisition date. So all those questions where you're going to see the concept of 103, he will only ask you a consolidation on acquisition date itself. But if he's going to ask you questions either on acquisition date or at a later date, he'll give you 2 balance sheets. And with the help of 2 balance sheets, and you will notice that in most of the questions, sometimes, in this particular case, most of the questions will be asked at a later date, generally, right? Okay, so far so good. I think that gives you a connect in terms of things. Now let's go further. Now, what do you want me, friends, to do? Start with a very basic question or start with something technical? You want me to do a question on case 1, 2, or you want to do something on case 3, 4? Sir, start with the basics. Start with something decent in hand. Okay, so I think let me take you first to the study material. I am carrying some questions which are given in the study material as well. But I think even those questions might be still okay types. Okay, let me see if we can give you something simple indeed. Okay, I think let's begin with a very simple question which is given in the study material. I think that would be better. So let me go to the study material, and there is a question which is given, question number 6, which is a very basic question indeed. So I think let's start with the basic exercise, then we'll turn to something basic to technical. Okay, that's wonderfully taken. Let's start with the basics. Let's see these steps. This is a question which is given in the study material. I guess it is in unit number 8, I guess. It's given to the unit number 8 at the back. I think that's good to go. So let me read the question with you. But trust me, I'm going to solve every question based on the 6 steps which I've given you, irrespective, even if it is a chain holding. We'll be doing questions on chain holding later. So let me just read the question and then we'll solve. It says on 31st March X2, Blue Heavens acquired 100% ordinary shares carrying voting rights of Orange County. It says for 6,000 lakhs in cash, and it controlled Orange County from that date. The acquisition date statements of financial position. The acquisition date statement of financial positions of both the companies are given. I want you to tell me, friends, which case is this? Is he asking me to do a consolidated balance sheet later or on the date of acquisition? Basanti, tumhara naam kya hai? On 31st March X2, you acquired 100% stake, and we are given the balance sheets of the parent and subsidiary on the date of acquisition. So this is a case number, you can say 1 out of the 4 cases I gave you, that you're required to make a consolidation on the date of acquisition without any NCI as well, because it is a 100% stake. So if you technically ask me, this is a case number 1 where we're doing a consolidated balance sheet on date of acquisition and there is no NCI. So first let's do one question on this and then we'll go step by step. So let's do all the 4 cases with you. I think I would have got some inputs also regarding the case, and that is rightly given. It is on the date of acquisition. Okay. So we're given the balance sheet of Blue Heavens and the book values are given. And we're given the balance sheet of Orange County and we are given the fair value as well. I need the net assets at a fair value to calculate the goodwill and do the consolidation. So this is the balance sheet which is given. Let's go further. So the only input which is further given in the requirement of the question is we need to prepare a consolidated balance sheet. We need to make a consolidated balance sheet on March X2 for both the companies put together. No additional information, nothing is given, plain vanilla question. Let's begin the journey. So let me start the inputs to you. You can keep the question open in front of you. Please keep the question in front of you from the study material. And I'm going to solve this particular question on a step by step. So let's have a look at the solution. This is the question number 5, which I just read. And we're going to start our 6-step model for consolidation. So let's begin with the step number 1. In terms of the step number 1, you just need to identify the date of acquisition and the percentage of holding. So we are very clearly given in the question. It says the date of acquisition is 31st March X2. So that is the date of acquisition. And the percentage is very clearly given. It's 100%. So that is clear that there is no NCI. Step 1 done. Now let's go to the step number 2. And in this case, since we are doing the consolidation on the date of acquisition. I don't need analysis of other equity. In this particular case, I can safely make a list of my net assets. Either you take equity, share capital plus other equity, or you take assets minus liability. Now, I would advise when it is a case number one and a case number two, as I said, you don't need analysis of other equity. Now, the problem is if you go to consider the sum total of the share capital and retained earnings, that will give you the net assets at a book value. If you go to add the share capital and the retained earnings, you're going to get the net assets at a book value. And then you'll keep adding the difference between the book value and the fair value of every asset and liability. So as I said, if it is a case number one and two, you can alternatively consider the assets minus liability. You cannot do that in case three and four. But in this case, I will simply consider the assets minus liability. So let's do one thing. Let us directly get the list of net assets at fair value. Let us directly get the list of net assets at a fair value. So let me begin from the balance sheet. There is building and other PPE. So there is building, etc. The fair value of this is given 3,300. And the next item in the balance sheet, inventory, is appearing at 600. I'm just picking up the items from the balance sheet, but we need to consider them at a fair value, not a book value. Then there is a trade receivables that is 250. And then we're also given the cash to the extent of 700. So this is all the assets taken at a fair value. And then on the liabilities, I think the only liability given is a trades payable, and that is 150. And I think that's it. So we get the net assets at a fair value. So remember, if it is a case one and two, analysis of other equity will not be done, but we need a net assets. So instead of taking the total of equity share capital plus the other equity, which will give you the net assets at a book value. And then you start adding the increase or decrease, which is comparing the book value of every asset and liability versus the fair value of assets and liability. Advisable not to use this approach. If you take the sum total of the share capital, other equity, and then add all the changes in the book value and the fair value, I think it's going to be long drawn exercise. So alternatively, this is a better approach that you directly make a list of all the net assets directly. So let's get the net assets at a fair value. So 3,300 plus 600 plus 250 plus 700 minus 150, that works out at 4,700 is the net assets. Okay. So that is my step number two, getting the net assets on the date of acquisition. So let me also put it like this. This is the net assets at a fair value on the date of acquisition. Okay, then we can go on to the step number three. And in terms of the step number three, we calculate NCI, but in this particular case, there is no NCI. 100% of the shares are held with the parent company, so there is no NCI. Step number three is not applicable. Then you go to the step number four and you calculate a goodwill or a bargain purchase gain, and you need to apply the concept of Ind AS 103. So let's consider the format, the purchase consideration plus the NCI, though we know it is zero, but at least we can put that in the format, and then compare it with the net assets on the date of acquisition, and we're going to get a goodwill. You need to be careful if there is any goodwill impairment, because once you calculate the goodwill, I'll reduce the goodwill impairment as well, but this is a plain vanilla question, so no goodwill is given, so not required. Now, when you're looking at the purchase consideration, that is nothing but investment in the balance sheet of the parent company. So if you go to the balance sheet of Blue Heavens, there is investment in Orange County, which is appearing to the extent of 6,000. That is the investment, that is the purchase consideration. The net assets we have already computed in step two, 4,700. So we are getting a difference that is 1,300, that becomes goodwill. Isn't that too simple and straight indeed? So 4 steps done. Now we go to the step number 5. And in terms of the step number 5, we need to calculate for the consolidated balance sheet the other equity which will appear. Now, in this particular case, I don't have any post-acquisition earnings. I am not given any status in terms of stock reserve. Nothing is given. So we can directly consider the parent company's other equity, which is retained earnings in this case. So if you look at the balance sheet given in the question, the retained earnings of the parent company is 10,200, and that's it. No post-acquisition increase, no unrealized profits, no adjustments altogether. And finally, we go to the step number 6, and we're going to make a consolidated balance sheet based on this. So once you're going to make a consolidated balance sheet, now just remember that you just need to keep the formatting, which is almost given in the question. So let's begin with the asset side of the balance sheet. And on the asset side, we've got, first of all, NCA. Now, careful. When you go to make a consolidated balance sheet, you need to remember that when you make a consolidated balance sheet, just in case to remind you what we have done under 103 as well, you will consider the parent and the subsidiary. So when you consider the parent company, you consider the book value. When you consider the subsidiary, you got to consider fair value, because you would have incorporated the assets and liabilities at a fair value. So when you go to consolidate, please remember to incorporate the fair values of the subsidiary. So we are given on the NCA, the first item is building, etc. So let me show you the breakup. So for the parent company, it is 7,000. And for the subsidiary company, the fair value, 3,300. And this will come to 10,300. Then as far as the next item in the balance sheet is concerned, it is investment. We've decided, as per the rules, investment will not appear in the balance sheet. And lest we forget, you can represent the goodwill as well. And I guess we computed the goodwill at 1,300. So goodwill will appear as a separate line item. And even as per the schedule 3, when you represent the goodwill, you know that your balance sheet begins with PPE, then followed by CWIP and investment property, then comes goodwill. So I've reflected the goodwill immediately after the PPE. Okay, then we're given the current assets as well. So let's pick up the current assets. And as far as the current assets are concerned, we're given inventories, then there is trade receivable, and then there is cash. So let's aggregate the values. So we're given the inventory is 700 for the parent, and for the subsidiary, the fair value is 600, and that works out at 1,300. Then the trade receivables is 300 for the parent, and it is 250 for the subsidiary. So that makes it a total of 550. And then there is a cash, which is 1,500 for the parent, and it is 700 for the subsidiary. That makes it a total of 2,200, aggregating the assets. I think that's it. So we can easily take the total of the asset side of the balance sheet. So let's add the assets. So 10,300 plus another 1,300 twice. Then there is 2,200 and 550. This is coming to 15,650 is the total of the balance sheet. So 15,650 is the total of the balance sheet. Now let's focus on the equity and liability side. So this is a very simple little question. I think it's something which you cannot expect in the exams as well. I think it's too simple to come, but we're doing basic exercise. Okay, now on the equity and liability side, we've got equity where we need to consider the equity share capital. And the rule tells me that we need to consider the share capital of the parent company only. So the share capital of the parent company is 5,000. And then we consider the other equity. And you've already done that in step number 5. So I don't need to do anything. Just go to the step number 5. That comes to 10,200. And lest we forget, you need to remember that if there is NCI, though in this case there is no NCI, NCI will be reflected as a part of the equity in the consolidated balance sheet. So when you're going to show the equity after the share capital and the other equity, you're going to show the NCI, though in this case it's not there. Then I think there is no non-current liabilities given in the question. So there are no non-current liability. And in terms of current liabilities, we've got trade payable. So just add the parent and the subsidiary, 300 plus 150, that makes it a total of 450. So this should agree my balance sheet. That is 15,650 is the total of the balance sheet. Wow. So that takes care of my consolidated balance sheet as well. I don't think so anybody would have any problems with this question because this was too simple. Consolidation on the balance sheet date with no presence of NCI, and we have applied our 6-step model. Right, friends? So far, so good. I guess everybody should be very, very comfortable indeed. Okay, Kriti, you've got a question. So this question can also be solved by 7 steps you gave in 103, as there is a consolidated balance sheet on date of acquisition. Well, I guess in that particular case, I would say yes. In fact, if you notice, your calculations, NCI goodwill is nothing, but it is exactly 103 only. So yes, indirectly, since it is acquisition on the balance sheet on acquisition date, you rightly said, we can practically do it. No exceptions, nothing is given. Correct. Absolutely correct. Right, friends. So I think everybody should be very comfortable. Now, let's go on further. This was like case number 1. Now we've got another one input, and that is like case number 2. This is an extension of the previous example, so that, before we go to the 3rd or the 4th case, where there is a consolidation later with a presence of an NCI, let's have a look at another one, question number 7. Okay, did I mark question 5? That was question 6. Okay, so I think I should mark this as question number 6. This is 6, not 5, so that it gets rectified later. This is question number 6. I marked it as 5. This is question 6 of the study material. Okay, now let's have a look at the question number 7, which is a little extension, not extension, but an independent part, but slightly different. The facts are same in question number 6. However, Blue acquires only 75% ordinary shares, and Blue paid 4,500 lakhs for these shares. We need a consolidated balance sheet on March X2. This becomes a case number 2, consolidation on acquisition date with an NCI. So trust me, I'm going on a step-by-step basis. As I give you 4 cases, we're doing questions also on 4 cases. I did number 1, no NCI, consolidation, acquisition date. Now, same question, NCI, consolidation on balance sheet date. So I think I'll take a liberty of changing the solution. I'll not do the question all over again. I'll just take the liberty of changing the question. Now it is a 75% holding. So let me use a different color. And I think on that, I can just slightly change the answer. The date of acquisition remains the same, but in this case, based on the data in question number 7, this percentage is become 75%. That's it. So this becomes a case of 75%. So instead of 100, we've got a 75% stake in this case. Okay. Does the step number 2 undergo a change? No. The list of net assets would still remain the same. That once you're making a list of the net assets, you need everything at a fair value. So this remains the same. Now there is an NCI in terms of the question number 7. You're going to get NCI, which is 25%. Now the question arises, when you go to consider the NCI, is it fair value of PASNA? I am nowhere given in the question that there is any fair value per share given. So this will be taken at PASNA. So we know that 4,700 is the net assets computed in step number 2. So you take 25% of this. So if I take 25% of 4,700, that works out at 1175. So I'm just making the changes which will be done. As far as the goodwill is concerned, there is going to be slight change because the PC is undergone a change. So we can say he is now changed that the consideration paid is 4,500 and the NCI we've computed is 1175. So this is what we're doing for question number 7. And this total works out at 4,500 plus 1175, 5,675. And the net assets remains at 4,700. So we accordingly get the goodwill that is 975. Okay, so I think I made the changes till the step number 4. With the presence of the NCI, we have made the calculations of NCI and even the consideration was different. So accordingly, we made the changes. Now let's go to the step number 5. Would the step number 5 undergo a change? No, because we're doing a consolidation on the acquisition date. So step number 5 also remains the same. Now we need to do the changes in terms of the step number 6. So let's see the changes in step number 6. Now, a little caution, a little caution. The investment in question number 6 was 6,000, but the investment in question number 7 is 4,500. So 1,500 lesser consideration paid. So I think I need to change the cash balance of the parent. Because if in the first balance sheet investment is 6,000 and in the next question it is 4,500, so that 1,500 less consideration paid would actually increase the cash balance. So in the question number 7, this should be read as 3,000. Because if you paid a lesser consideration by 1,500, the cash of the parent would have been higher by 1,500. So let's now consider, would the building remain the same? Yes. Has the goodwill undergone a change? Yes, the goodwill has undergone a change at 975. Aggregation remains the same, but goodwill undergoes a change. Inventory is same? Yes. The trade receivable is same? Yes. But the cash balance 1,500 more, that works out at 3,700. So let's see the total of the balance sheet. So the only changes I've done is the figure of goodwill undergoes a change and the amount of cash undergoes a change. So 10,300, 975, 1,300, 550 and 3,700. This is 16,825. That works out at 16,825. Now let's see the liability side, equity and liability for the question number 7. The equity share capital remains the same. The other equity remains the same, but now you've got NCI as well. So NCI we've already computed is 1175. So we get an NCI and the trade payables remains the same. So let's see if the balance sheet is agreed on that. So 15,200, 1175 and 450, this works out at 16,825 and the balance sheet is agreed. Well, so I think we're done with 2 cases to give you the consolidation on the acquisition date, no NCI and NCI, both the cases done. I think your comfort zones at this stage on the consolidation on the acquisition date should be almost like 8 and above. But I'll still like to get your comfort zone scores, because in this particular case, no calculations of analysis done. It's a plain vanilla questions where the step number 2 is just getting a list of net assets. That's it. So give me your comfort zones, friends, on the case number 1 and the case number 2. Because now we need to go to the case number 3 and 4, though case number 3 and 4 is almost similar. Case 3 is no NCI consolidation later. Case 3 is NCI consolidation later. I think we can handle both the questions now, case 3 and 4. So let me first get your comfort zones at this stage before we go further. Okay, we got the scores 8, 9, 9. That's wonderful indeed. I think that's a pretty comfortable zone. So I think now the things will get slightly technical. So what I am now going to do, I am just going to take you to the question and you will just identify the case. Let me just go back. Let me just go back and I'm just carrying another question with me. So you're going to see the question and help me in identifying which case is this. So I've added a particular question. This is question number 16 and we're just going to read this question. You will help me in identifying which case is this. Let's read. So now we'll start getting some more adjustments as well. It says Hold Limited acquired 100% ordinary share. So we acquired 100% ordinary share on 1st October 17, and on March 18 the balance sheets are given. The acquisition date is 1st October 17 and the balance sheet date is March 18. So naturally the consolidation is done at a later date and the percentage is 100%. Would you like to tell me which case is this according to the four cases I gave you? And that's rightly said. It is supposed to be, okay, now that was a score, 10 out of 10. Wonderful indeed. That's great. So can I say this is going to be case number 3? Where we are making a consolidated balance sheet at a later date and there is no NCI. So we'll be concentrating on this particular case, but there will be a few adjustments also coming in this case. But I think it is a right time to give you a break before we do this particular case. Otherwise, it's going to take a little long. So I think 8:40 by the clock, so 10 to 12 minutes break. Then I think we're going to do this particular question with our 6-step model. Right, friends. So I think let's give you a break now. Enjoy your mind, relax your mind, and we'll start back. Welcome back, friends. So I hope you had a relaxation of mind. So now I think let's come back to the case number 3, which we were just reading the question, and there will be a couple of more adjustments. So this could be a slightly little more complicated as compared to the previous case 1 and 2. So let's, I think, start reading. So we were reading this particular question. Okay, so I think let's begin with this. So it says hold acquired 100% ordinary share on 1st October 17 and on March 18, the balance sheets of both the holding and the subsidiary is given. And then it says in the additional information, the retained earnings of the company showed a credit balance of 6 lakh on 1st April 17. That's at the beginning of the year, out of which a dividend of 10% is paid on 1st November 17. The holding credited the dividend received to the retained earnings account. So what they did was absolutely correct. Let me, I think, tell you one thing at this stage. Unlike what you might remember in terms of IGAP, that when you receive a dividend under IGAP, we used to consider that this is pre-acquisition and this is post-acquisition. And accordingly, as per accounting standard 13, you used to credit the investment if it is pre and the credit the P&L if it is post-acquisition. There is nothing of that sort in terms of Ind AS. The accounting treatment in terms of Ind AS is absolutely straight, that whatever dividend you receive from the subsidiary company is your income, and that would be taken in the retained earnings. So all that concept in terms of pre-post acquisition crediting investment is something of the past. In terms of Ind AS, dividend received, whether it is pre-post, whatever, is taken to the retained earnings of the parent. So what the parent company did was absolutely correct. But let me also tell you that if you look at from the consolidation point of view, it's like a subsidiary paid a dividend to the parent company, and it is supposed to be, an income within the group. You're paying yourself and you're receiving yourself. So in any case, when we're going to make a consolidated balance sheet, this dividend, which is rightly credited in the books of the parent company, is going to be eliminated in the consolidation process, because it is not an income received from the outsider, but it is received within the group. So we're going to eliminate this when we come to the retained earning calculation, I would say in terms of step number 5. Then he says there is no fresh addition to other reserves in both the companies during the current financial year. So we're given some other reserves in the balance sheet apart from retained earnings. He says there has been no fresh additions to these reserves during the year. There was no opening balance in the retained earnings in the books of holding company. Following on the changes in the fair value as per the respective Ind AS from the books values on 1st October 17. So now we are given that there is some sort of fair value adjustments. So we are given that there are certain fair value adjustments which are done on the date of acquisition. And we know that as per Ind AS 103, when you consider the assets and liability, you need a fair value. So he says the fair value of the plant and machinery is given. There is a depreciation rate also given. Land and building is appreciated, and inventories increased, and trade payables also increase. So difference between the book value and the fair values are given. We need to make a consolidated balance sheet on March 18, and the balance sheet should comply with the relevant Ind AS and Schedule 3 to the Companies Act. This was a May 2018 examination question, 15 marks. Let me also tell you that May 2018 was the very first attempt of the new course, what you're studying right now. But this is, again, what you're doing is another version of the new course, which is going to be applicable in May 24. But the course content remains the same, except for a few additions and which are there now in the course. So May 18 became the first attempt when Ind AS became first applicable in CA final examination. So you can see some sort of adjustments which are given. Now, as I'm going to solve this question, I'm going to say a couple of more things to you, which I did not say when I gave you a 6-step model. So please be very careful. The next half an hour, 45 minutes is going to be very crucial, because I'm going to say a couple of more things which I've not even said earlier in the class today, or I've made any documentations as well. Let's begin. So this is May 18 examination question. I think if you want to keep the question in front of you, you can immediately also download it from the website of the institute. Go to the BOS Knowledge Portal if you have that question. Otherwise, go to the BOS Knowledge Portal, past examination paper, May 18 paper, you'll get that. So I think let's start the journey in terms of our 6-step model on this. So let's begin. Well, first of all, we start with the step number 1. And in terms of step number 1, we just need to get the date of acquisition and the percentage in this case. So let's see the date of acquisition and let's see what is the percentage of acquisition. Very clearly, I am stated in the question that the date of acquisition in the very first sentence is given 1st October 17. So we are given the date of acquisition is 1st October 17. And if you look at the percentage, it is very clearly given that you acquired 100% stake. So there is no NCI. Step 1 is pretty simple and straight indeed. Now we come to the step number 2, and the moment you come to the step number 2, you need to take a conscious call that am I going to consider step 2 or step 2A and B? Now, in this case, since the consolidation is taking place later, we need to organize the step 2 in 2 parts. We're going to go to the step number 2A, where we're going to consider the analysis of other equity. We need the analysis of other equity of the subsidiary company. Now, please watch this step very carefully. When you're going to do the analysis of other equity, now let me give you some focus points. First, you need to draw your chart very carefully. I would say when you do this analysis of equity, first of all, create a column for a particulars and then create 2 columns. One is for a pre and one is for a post acquisition. So the moment you turn to the analysis of equity, get your charts very clear. I'm going to create a column for particulars. That is 1. We're going to create a column for pre-acquisition period, and we're going to create a column for post-acquisition period. So before you start the analysis, organize the columns pre as well as post-acquisition. Define in terms of the dates what is pre and what is post-acquisition. Whatever is earned before the date of acquisition is pre, and whatever is earned after the date of acquisition till the balance sheet date is post. So we'll define that the pre-acquisition is supposed to be pre-1st October 17. Any profits earned by the subsidiary company before the date of acquisition is pre. And the post-acquisition begins from the date of acquisition, that is 1st October, and it ends on the balance sheet date, that is March 18. So take a note of the fact after reading the question that this is the pre-acquisition period, and from the acquisition date till the balance sheet date, it is post-acquisition. And take a moment before, many people go wrong. We can see the current financial year 17-18, 6 months of the current financial year is in pre and 6 months of the current financial year is in post. Because what happens sometimes, the balance sheet might be prepared on March 20, then you need to be careful that the entire current year is post. So we need to be careful, like in this particular case, out of the current year, 6 months is pre and 6 months is post. Now, as you start with this analysis of other equity, I would say you need to keep 3 focus points. Go on a stage by stage so that you don't go wrong. My advice is that at the first stage, your focus point is to look at the balance sheet of the subsidiary. Only concentrate on the balance sheet of the subsidiary. Look at the retained earnings and other components of equity and do the analysis. That is focus 1. Second, I would say go to the additional information and look for any kind of fair value adjustments. So the additional information will give you that on the date of acquisition, if the difference in the book values and the fair values are present, take care of those fair value adjustments. Then the focus number 3 is to look at the additional information again and see if there is any stock reserve information, which is upstream in nature, not downstream. So when you do the analysis of other equity, my advice is three focus points should be there at the back of the mind. So in the analysis of other equity, my advice is that whenever you do the analysis, keep the three focus points very clear. So when you consider this, number one, you need to be very clear that I am going to look at the other equity in the balance sheet of the subsidiary company. So first, just concentrate on the balance sheet of the subsidiary and do the analysis of other equity. Then go to the additional information. And when you go to the additional information, look at any fair value adjustments, if any. And then again, look at the additional information and see for any stock reserve, which is upstream in nature. Because as I gave you earlier, if there is any unrealized profits, downstream is taken care in step 6 and 5. But upstream is taken care in step number 6 and step number 2A. So watch out the additional information for stock reserve and any fair value adjustments. So your mind will be very clear that when you're doing this analysis, what are the major focus points to be taken? Okay, let's now begin. So now look at the balance sheet of the subsidiary. If you look at the balance sheet of the subsidiary, we can clearly see on the equity side, there is other reserves as a part of other equity and there is a retained earnings. So we'll take one by one analysis of every item of other equity. So let's begin with the analysis of other reserves. Now, I would say that go on a very systematic manner, draw a time scale as you do the analysis of each and every component of other equity. Don't be in a hurry. Hurry can make a curry. So in this particular case, when you do the analysis of the other reserves, make a time scale and create a current year scale. So we can say the financial year begins on April 17 and it ends on March 18, and the date of acquisition is supposed to be 1st October 17. Create a time scale and note down the dates carefully. This is the current year 17-18 and this is the date of acquisition. Now, let's take a time and go to the balance sheet. See what is the position of other reserves in the balance sheet of the subsidiary. The other reserves appearing in the balance sheet of the subsidiary on the balance sheet date is 20 lakhs. Note it down that this is the balance on the balance sheet date. Then go to the additional information and see what is the status of the other reserve. He very clearly says in the additional information, there is no fresh addition to other reserves in case of both the companies during the financial year. So there has been no movement in terms of other reserve. If there has been no movement, we can clearly say that even at the beginning of the year, the balance was 20 lakhs itself. So there has been no movement. You can say there has been no movement during the year in case of other reserve. So get this data, organize this data very carefully as a part of your time scale. Look at the position at the beginning or look at the position on the date of acquisition and what is the position at the end of the year. Now, let's go on with the analysis. This 20 lakh is a balance on 1st April 17. So undoubtedly it was earned before the date of acquisition. So it is definitely pre-acquisition in nature. There has been no movement during the year, so there has been no post-acquisition increase which has taken place. And you need to be careful. You need to be careful. Say, for example, that this was 20 lakhs and he said the balance at the beginning is 15. If the balance at the beginning is 15, there is an increase of 5 lakh and this increase of 5 lakhs is going to be divided in a time ratio. This increase will not be considered as post because you're given the balance of 15 on beginning of the year, not on the date of acquisition. You need to be very careful on your analysis. Had I been given the balance on the date of acquisition, the entire increase would have been post. But since I'm given the balance at the beginning, the increase will be divided in the time ratio. In this case, it is 6 months, pre and post. So 1:1. Okay, so this takes care of the other reserve. Let's carry on the further analysis. Let me do the further analysis of equity. So continuing with this. So continuing with the same format, a column for particulars, then pre and post acquisition in nature. So this is pre and this is post. So analysis of other reserves is done. Now we will pick up the next item in the balance sheet of the subsidiary. The next item in the other equity is retained earnings. So let's pick up the retained earnings and again create a time scale. Again, create a time scale. This is important so that you don't go wrong. The financial year is April 17, ending on March 18, and the date of acquisition is 1st October 17. So that is the date of acquisition. Every time you do the analysis and your focus is the balance sheet of the subsidiary, do make a time scale, note down the informations, what is the balances on each date. Retained earnings on the balance sheet date is given to me 16.4 lakhs. This is what is given in the balance sheet of the subsidiary. Now let's go to the additional information. The additional information says the retained earnings of the subsidiary shows a credit balance of 6 lakh on 1st April 17. The balance on 1st April is 6 lakh rupee. So we can very clearly see that there is definitely a movement during the year. Now, friends, be a little cautious because this is a point where many people tend to commit blunders. So see what it says in the additional information. It says the retained earnings had a credit balance of 6 lakh. I think let me just take you back on the question. So we can just read, see what is given in the additional information. It says in the additional information out here, the retained earnings shows a credit balance of 6 lakh on 1st April 17, out of which a dividend of 10% is paid on 1st November 17. Now, please remember your date of acquisition is supposed to be 1st October and the dividend is paid on 1st November. The dividend is paid after the date of acquisition. Now, let me just go back and tell you something very interesting you need to be careful on. Now, please hear this very carefully. Please see this very carefully. Now, first of all, what I'm going to do in this particular case, out of the 6 lakh, we paid a dividend. Since we paid a dividend, 6 lakh is no longer available. I know that this was the balance on 1st April, but we are doing this analysis on the balance sheet date. Since we're doing the analysis on the balance sheet date, this 6 lakh is no longer available because you paid a 10% dividend. So on the share capital of 40 lakhs in the balance sheet of the subsidiary, a 10% dividend is paid. So on 40 lakhs, a 10% dividend is paid. So what is still available out of the 6 lakh is only a balance to the extent of 2 lakh. That's one. Which means you need to now compare this 2 lakh versus 16.4. You cannot compare 6 versus 16.4 because this is after dividends and this is before dividends. So you need to get the status. Now this 2 lakh is after dividend and 16.4 is after dividend. You need to bring them to the common base. So when you consider the balance at the beginning, you need to know that this balance is no longer available on the balance sheet date. So this increase works out at 14.4 lakhs. This is the increase in the profits during the year, which needs to be divided in a time ratio. Now, let me tell you something more interesting, which can be confusing, but you need to keep this in mind. My technique tells me when you're going to do the analysis, we will say this 6 lakh is the balance on 1st April. It is definitely earned in the pre-acquisition period. Put it in the outer column. So, why are you putting 6 lakhs in the outer column when still available is 2 lakh? Why did you write 6 lakhs and not 2 lakh? My advice is please don't write 2 lakhs out here. My advice is write down the figure which is without dividends. The reason I'll tell you. The objective of doing this analysis is to get the net assets on the date of acquisition. Please mind the words carefully. The objective of doing this analysis is to get the net assets on the date of acquisition. And if you need the net assets on the date of acquisition, we are working on the concept of taking equity share capital plus the pre-acquisition profits on the date of acquisition, and that will give you the net assets. Since I want the net assets on the date of acquisition, you're taking share capital plus pre-acquisition profit. And you need the net assets on the date of acquisition, 1st April 17. At that time, the dividend was not paid. So the net assets available on that date was based on 6 lakh and not 2 lakhs. I hope you got the picture. Let me put it again. You know why I'm doing this particular analysis? I'm doing this analysis for the reason I want to get the net assets on the date of acquisition on 1st October. So your net assets will be share capital plus the pre-acquisition profit. Now, when you need the net assets on 1st October, it is without making a payment of dividends. The dividends were paid on 1st November. So at that time, the net assets available is 6 lakh, including a profit of 6 and not 2 lakh. Therefore, my advice is that when you do the analysis, write down the figure of 6 lakhs because you need the net assets before making a payment of dividends. Okay. Now you would start asking me, sir, if the dividend was paid before the date of acquisition, well, I think in that particular case, naturally you will subtract and write the net figure. But in this particular case, since the dividend was paid on 1st November, in this particular case, we need to be careful that please do not consider the subtraction of the dividend. So then why did you reduce 4 lakhs and calculate the figure? Well, I reduced the figure because if you want the increase, you can't compare 6 versus 16.4. If you want the increase, you need to compare both the figures after dividends. So reducing this dividend is to get the increase, but when you consider a figure in the outer column, this should be taken before dividend on a safe side. You should take this figure before any dividends on a safe side. I hope my logics are clear. And then this increase is going to be divided in the time ratio 6:6. So 7.2 lakhs becomes pre and 7.2 lakh becomes post. So this is how we do the analysis in terms of retained earning. This was the first question where the concept of a dividend is given. So be careful when you do the analysis, a time scale, and then decide that what is still available after payment of dividend so you get the right increase. But when you take the pre-figure in the outer column, remember to take it before any dividends. Okay. So this is phase one. As I said, there are 3 focus points. One is the balance sheet, other equity of the subsidiary, done. Now let's go to the fair value adjustments and why we are talking in terms of fair value adjustments. Let me also tell you that as well. You know, when you go to consider the equity share capital and the pre-acquisition profits, if you go to consider the pre-acquisition profits based on the balance sheet figure, you are taking the net assets at a book value. The other equity appearing in the balance sheet is supposed to be without any fair value changes. So when you're going to take the sum total of this, you get the net assets at a book value. So what is important is that you should also consider the fair value increase and decrease as a part of the analysis. So when you go to adjust the fair value increase and decrease as a part of the analysis, this will automatically convert the net assets at a fair value. If you remember, as I did the very first question today, I said, let's take the assets minus liability. That was possible in case 1 and 2. I said, if you go to consider equity share capital plus the retained earnings, you need to adjust the fair value increase, decrease as well. Now, in the case number 3 and 4, I have to do that. Since I'm going to consider net assets as a total of share capital plus the pre-acquisition profits, the balance sheet figure of retained earnings is without fair value changes. So you will get the net assets at a book value. So as a part of the analysis, it is important to incorporate the fair value changes, if any, as a part of the pre-acquisition column. So which means I've said another important thing. These fair value adjustments will always be taken pre in nature because they are being done on the date of acquisition, and since they will be done on the date of acquisition, so we can say all these fair value increase, decrease will always be entered in the pre-acquisition column. So now let's go further. I think I'll take a little extended version. Let me properly show you the calculations of the fair value adjustments as well. So we are still on the analysis of other equity. So you can see the moment we are on case number 3, it has become definitely a little more complicated as compared to the case 1 and 2. So this is pre-acquisition, this is post-acquisition, and this is my particulars column. And we're working on the second focus point, that is fair value adjustments to be taken in the pre-acquisition column. Okay, now once we look at the fair value adjustments, we are clearly given in the additional information in point number 1, fair value of the plant and machinery on the date of acquisition is 40 lakhs. Now my advice is, when you consider plant and machinery, I would say in this particular case, again, make a time scale to see the figures very clear. So let's consider a time scale. My financial year is April 17 and ends on March 18. And my date of acquisition is supposed to be 1st October 17. That is the date of acquisition. So let's get the status very clear, because if you don't create a time scale, maximum people tend up doing some wrong calculations. Now, what's this? He's given you in the point number 1, the fair value of the machinery on the date of acquisition is 40 lakh. So I am given the fair value of this machinery on the date of acquisition is 40 lakh. Now let's go to the balance sheet of the subsidiary. If you look at the balance sheet of the subsidiary, the plant and machinery is appearing to the extent of 27 lakhs on the date of acquisition, on the balance sheet date. This is the book value of the machinery on the balance sheet date. Now, we are very clearly given in the question that as far as a depreciation rate is concerned, we are considering a 10% depreciation rate. If you're considering a 10% depreciation rate, we can say this represents 90%. Because if this is after considering a 10% depreciation, this represents 90%. So we can say the book value at the beginning of the year is going to be 30 lakhs, grossing it up. 10% is the depreciation rate. So we can say that 27 lakh represents 90%. Of course, assuming depreciation is WDV method. Now, you cannot compare this 30 and 40 because this is at the beginning and this is in the middle of the year. So you need to get the book value which is on the date of acquisition. So to get the fair value changes, the gain or loss, you need to get the book value on the date of acquisition. So what I'm going to do, I would consider out of this 30 lakhs, a depreciation at the rate of 10% for a period of 6 months to get the book value in the middle of the year. So that works out at 28.5 lakhs. So see, with the help of my time scale, we are able to organize the data very systematically. You know the fair values on the acquisition date, you know the book value at the end of the year, you gross it up and get the book value at the beginning. And then you try to get the book value at the date of acquisition after considering depreciation up to the date of acquisition itself. So now we are in a position to compare these values. And we can say that the difference 11.5 lakh is supposed to be the increase in the fair value compared to the book value. So this increase in the fair value is going to be taken in the outer column, that is in the pre-acquisition 11.5 lakhs. But that's not the end. That's not the end. If you change the valuation of the asset, then the depreciation will also change on a prospective basis, not retrospective, but I said it is going to change on a prospective basis. So immediately when you do this revaluation change, you need to consider that there will be an additional depreciation to be worked upon this increase as well. So now the question rises that when you go to work upon the additional depreciation, what is the value on which this additional depreciation will be done? Simple maths we'll apply. We have taken a depreciation 30 lakhs for the entire year, but we should have taken a depreciation 30 lakh for the first 6 months. Then we should have taken a depreciation on 40 lakh. So the company took a depreciation of 30 lakhs for the entire year, but they should have taken 30 lakh for the first 6 months, but then they should have taken a depreciation on 40 lakh. which means you've taken a depreciation on 30 lakhs for the next 6 months also, but you should have taken a depreciation on 40 lakh for the next 6 months. So when you're going to consider the additional depreciation, we can say we need to consider an additional depreciation between the difference in 40 and 30 and 10% depreciation rate for a period of 6 months only. So we took a depreciation on 30, but we should have taken a depreciation on 40. So there is a need to consider additional depreciation on that 10 lakhs for 10%, 6 months. I think that works out at 50,000. And we're going to take this in brackets. And this is since prospective in nature. So we are making a deduction in terms of the post-acquisition column. Wow. So that takes care of one fair value adjustments, but there are more fair value adjustments to be done. We're also given some fair value adjustments in point number 2, 3, 4. So let me do an extended version of this analysis further. So in short, let's consider columns for particulars, pre and post, and do the extended analysis. So this is pre-acquisition, this is post-acquisition, and that is particulars. And let's consider other fair value adjustments as well. The point number 2 tells you that the land and building is appreciated. So there is an increase, and this increase is by 20 lakhs. It becomes pre-acquisition. I am not given the status of any depreciation rates on the building. So in the absence, I will not be able to consider any additional depreciation. Then there is increase in terms of inventory. So inventory is also increased on the date of acquisition, and that is to the extent of 3 lakh. And there is also increase in a trades payable as well. But remember, increase in the assets is a gain to me, but increase in terms of liability is a loss to me. So trades payable increased by 2 lakhs. Let's put this in brackets because it is a loss. The gains without the brackets and the loss with brackets. So you can see the need of going on a systematic basis becomes even more important. So let me just consolidate the picture before we go further. So as I said, when you're doing the analysis of the other equity, I would say your focus is to be 3 points. You need to focus on the other equity of the subsidiary balance sheet status. You need to focus on the additional information on the fair value adjustments. You need to focus on the additional information on the stock reserve. So what I did, first of all, I concentrated in terms of the subsidiaries balance sheet, did the analysis of other reserves, and did the analysis of retained earnings. And in retained earnings, your focus in terms of dividend was very important. You need to be careful that when you do the analysis of the retained earnings, you get a figure which is 2 lakhs still available, but you need to take a figure which is without reducing dividend because I need the net assets on date of acquisition. And on the date of acquisition, what is still available is 6 lakh and not 2 lakhs after dividend because dividend was paid later. So we'll keep this in mind that I need to concentrate and write a figure which is without dividends. Get your changes? This is focus point 1 done. Then, since you need a net assets at a fair value, so you need to incorporate the fair value changes as a part of the analysis because equity share capital plus the pre-acquisition will give you net assets at a book value. So all the fair value changes will be taken and we made a time scale to get the increase and then prospectively the change in depreciation. That was the focus number 2. The increase decrease is always pre, and the additional depreciation or the excess depreciation is going to be done post prospectively. Now let's see in the additional information if there is any third focus point in terms of stock reserve. We are not given any stock reserve positions, no upstream, that's it. So I think this gives me the analysis of the other equity. So let's get the sum total of this. So let me take the sum total of the pre and the post columns from the very beginning. So in the pre column, we've got 20 lakhs out here, and then there is 6 lakhs, and then there is 7.2 lakhs. So this is 7.2, and then there is 11.5, and then there is 23 minus 2. I think it is coming to 65.7 lakhs in the pre column. If you add up all the pre-acquisition figures, this is the net figure. Let's go to the post figures as well. This is nil, and this is 7.2, and then it is minus 50. So 7,20,000 minus 50. This is coming to, I think, 6.7 is the net figure in the post column as well. I hope, friends, you got my analysis very, very clear, right? I hope everybody is pretty much clear on the technique of my analysis. Please do this question with your own hands today, because when you're going to do it with your own hands, your focus points will be very clear. This is what I need to be careful in terms of step number 2A. This is what I need to be careful when I do the fair value adjustments. Every point has to be very clear with you. Interestingly, let me also add something of late in the examination. There is something more interesting which is happening. They're also giving you the impacts of deferred taxations along with the fair value adjustments. And I think I'd like to say something at this stage. When you go to consider these fair value adjustments and you're given a tax rate in the question, that could also trigger the deferred tax implications as well. When you go to consider the fair value increases, it means the carrying amount is more. As we've done in Ind AS 103, the carrying amount is more, which is equal to the fair value, but the tax base is less. So in all the cases when there will be a fair value increase in terms of assets or in terms of liability, it will always lead to the concept of a deferred tax liability. So you need to be careful that if there is any tax rate givens along with these fair value adjustments, a deferred tax implications could also be given. So we can see that later once we come to a question of that sort, but that's also important. Okay, this was step number 2A. Now let's go to the step number 2B. And in terms of the step number 2B, I need the net assets on the date of acquisition. And as we said earlier, when you go to consider the net assets on the date of acquisition, you got to consider the sum total of the equity share capital plus the pre-acquisition profits. You're going to consider the equity share capital and the pre-acquisition profits. So equity share capital of the subsidiary is given in the balance sheet in the question, that is 40 lakh. And if you look at the pre-acquisition, this is 65.7 lakh. This is 65.7 lakh. So we can add this. This is 105.7 lakhs. So this becomes the total. You can say net assets on the date of acquisition, 105.7 lakh. And just to recall, I had taken the figures in the outer column as 6 without reducing the dividend of 4 lakh because I wanted to derive the figure which was there on the date of acquisition, because this is the figure which will help me to do the calculations of the net assets, to do the calculations of the goodwill, because I need the net assets on 1st October, not after dividends, because dividends were paid later. So therefore, to get this figure, we've taken that 6 lakhs in the outer column. Okay, so that is step number 2B. Now let's go to the step number 2, step number 3. So now let's come to the step number 3. And in terms of the step number 3, we need to consider the NCI. Now, as we go to consider, in this case, there is no NCI, so there is not applicable because 100% is held. Now, even if there is an NCI, then in this particular case, it could lead to complications. I think I want to discuss slightly on that part. If you're comfortable, friends, can I take the opportunity of doing some technical discussions with you? I think as it is today, I've not done too much technical, heavy discussions indeed. So I think I can take a little liberty of discussing a few things. Okay, Uday says, sir, I think there is no difference between mathematical calculations AS 21 and Ind AS 110. Yes, practically quite similar as you rightly said. But the only thing is that in terms of AS 21, the concept of pre and post acquisition dividend used to bother us. But in this case, even that is not bothering. So many of the procedures are, yes, you can say rightly, quite similar in nature. Okay, now in this particular case, there is no NCI, but I think I want to do a little discussion at this stage. Maybe what I am discussing may bounce back but I think I still want to take a risk. Let's say if there was an NCI in this question, I would have taken the NCI on the date of acquisition, and then I would have added the share in post-acquisition profits. Then I would have added the share in the post-acquisition profits to get the NCI. Now, please hear me very, very carefully, because I need to give you how the dividend is going to disturb my calculations. Now, first of all, when you consider the NCI on the date of acquisition, let's say I am considering Pasna. When I'm going to consider the NCI on the date of acquisition, let's consider, in this case, I am taking Pasna. So I would say, what is the net assets on the date of acquisition? I would say it is 105.7. So I would say the net assets is 105.7, and I would take the percentage which is held by NCI. So I will say this is the net assets on the date of acquisition into the percentage. Now, I cannot afford to do this. I cannot afford to do this, friends. Please hear me carefully. I'll now first give you the inputs why I can't do that. So please hear me carefully how this dividend is going to change my things. This next 5 minutes is very crucial in terms of my discussion. So please get it very, very clear. I am calculating a goodwill and I'm calculating an NCI. Now, you need to watch out one thing. I did the calculation of the net assets before dividends. And I did the calculation of the net assets after dividends. Please watch this very carefully, what I'm doing, so that there is no confusion and you know what you need to do when a dividend is given. So, we know the net assets before dividend is 105.7 lakhs. And if you consider after dividend, then you can say from this, you reduce that 4 lakh, which is the dividend, that comes to 101.7. So let's keep the focus very clear that this is a net assets without reducing dividend, and this is the net assets after dividend. Now let's see what I want to discuss with you. When I am looking at the calculation of a goodwill, when I'm looking at the calculation of goodwill, this is the goodwill computed on the date of acquisition itself. This is the goodwill on the date of acquisition itself, which means you compare the PC plus the NCI and you compare it with the net assets at a fair value. So when you calculate a goodwill, you take the PC plus NCI and compare it with the net assets at a fair value. So you need the NCI, which is based on 105.7 lakhs. You need the net assets also 105.7 lakh, because this is as on 1st October. So as on 1st October, the dividend was not paid. As on 1st October, the dividend was not paid. If the dividend was not paid, you will take the calculations of NCI on the net assets without dividend. You're going to consider the net assets also without dividend. Your goodwill calculations will be based on ignoring the dividend payments, because dividend was paid later after the goodwill was computed. I hope I'm very clear. So when you go to consider the NCI, base it on 105.7. Your net assets on 105.7. Now, let's go to the next one. When you're considering the NCI, your NCI is being computed on the consolidated balance sheet date. You need an NCI for the purposes of balance sheet. Goodwill is reflected on the balance sheet date, but it is the same computed on acquisition date. It is computed on date of acquisition, reflected on the balance sheet date, year by year same. But when you calculate the NCI, you're calculating the NCI on the balance sheet date. Therefore, in this particular case, when you consider the NCI on the date of acquisition, you need to consider based on 101.7 lakhs. Because I'm calculating this NCI on balance sheet date March 18 after dividend. So you're going to take this into the percentage held with the NCI and then add the post-acquisition increase. Which means the NCI which you're going to consider in the NCI step is not the same which you take in the goodwill step. So when you're going to consider the NCI for NCI purposes after dividend, when you're going to consider the NCI or the net assets for goodwill before dividends. Sir, can you put this once again? This has got really technical indeed. But I hope, friends, you've been able to catch up with what I am saying. Okay, Uday, you said, so please tell the difference between interim and a proposed dividend and a final dividend. Well, when you're looking in terms of this dividend, this is a dividend which was proposed for a last year and paid in the current year. It's a final dividend. The question is giving us the status of the dividend which was proposed, for the previous year and paid in the current year. It is called a final dividend. Interim dividend is something which is for the current year, paid in the current year itself. So interim dividend is something which is for the current year, paid in the current year, declared, paid everything in the current year. That is interim. But this dividend, what is given in the question, is paid out of the balance at the beginning. So it is a dividend in this case. You can say for the year 16-17, which is being paid in the year 17-18, right? I guess that's clear. So let me get the quick inputs again, because I thought, before we go to the case number 4, where there is going to be an NCI, this dividend is going to disturb you further. This dividend is going to disturb you further. So let me consolidate the picture. Now, what do you need to be careful on? Now, let's get the focus points. What do you need to be careful on in terms of dividend? If in the question you are given the status of dividend, I'll put it like this, what you should do. Let me get your focus points very clear. I think let me put it like this, that if in the question you are given a dividend information, so let's get the focus points clear. What do you need to do? Because once you're very clear in terms of the focus points, there cannot be mistake. I've given you the logics as well, but you need to be clear, what is to be done at what place. So my piece of advice, when you're going to get a dividend in the question, so what are the focus points we need to be careful on? When you do the step number 2A, that is analysis of other equity. When you do the step number 2A, that is analysis of other equity. That is one focus points which you need to be careful on. So what my advice is, you will take a column for pre and you will take a column for post. And my advice is, when you consider the retained earnings, take this figure before subtracting dividend. Take this figure before subtracting dividend. Because my analysis is being done for the goodwill calculation. Since my analysis is done for the goodwill calculations, I need the net assets without reducing dividend. So take this figure, which is before dividend. So automatically, when you do the step number 2B, you will get the net assets, and this net assets will be equal to the equity share capital and the pre-acquisition profits, which is before subtracting the dividends. So that will take care of my goodwill portions. Focus point 1. Then the second focus point is when you go to the step number 3, and the next focus point is when you go to the step number 4. So what do you need to do? In terms of the step number 3, you're calculating the NCI. And in step number 4, you're calculating the goodwill or the bargain purchase gain. So now the focus point is NCI is on the balance sheet date. So when you're focusing on the NCI is on the balance sheet date, so what are you going to do? If your NCI is taken at PASNA, If the NCI is taken at Pasna, you need the NCI on date of acquisition. So when you need the NCI on the date of acquisition, what you need to do, you need to consider the figure after dividend. Take the net assets after dividends. Because you're calculating the NCI on the balance sheet date. So on the balance sheet date, dividends have already been paid. So you're going to consider the NCI on the date of acquisition based on the net assets after dividends. And then you can add the post-acquisition share as well. Whatever is the post-acquisition profit share, that can be added. So here the focus is after. So you take before and then you take after, and then it comes to goodwill. So when you consider the goodwill, in this case, you take the purchase consideration and you just add the NCI to this, and then you compare it with the net assets and you get the goodwill figure. So get it very clear. Don't even do the mistake of taking the NCI from here. Never ever. ये गलती कभी मत करना जिंदगी में. ये NCI आप स्टेप नंबर 3 से नहीं लेंगे. अगर क्वेश्चन में डिविडेंड्स आपको दिए हैं, प्लीज डू नॉट टेक दिस NCI from the step number 3. Because when you're going to consider the net assets and the NCI, you need based on before dividend. You need the net assets before dividend. So this is the focus points which you need to keep very clear. You'll never ever go wrong in the question. Because you need to be very clear, what are you computing? Goodwill is on the acquisition date, so before dividends. NCI is on the balance sheet date, so after dividend. And therefore, we are organizing this data before dividend. This is the main focus you need to keep in. And of course, another thing which I'll just like to add on, which I'll be doing later as well, and that is when you go to the step number 5, this is a part of the dividend in step 5. When you take the other equity in the consolidated balance sheet as well, so you need to remember that you need to reduce the dividends out of step number 5 because it's not an earning from a group point of view. So when you go to the step number 5 as well, reduce and eliminate the dividend because it's not income from the group point of view. Focus points. So I hope, friends, I am pretty much clear on this. I guess I'm very clear on my agenda as far as dividends are concerned. Nobody? We'll be doing another question in the next class as well on case 4, where there will be dividends, there will be NCI, and I will give you more focus on this, but I wanted to give you something at this stage itself. Okay, so step 3 is not applicable in this case. Now let's go to the step number 4. So let's go to the step number 4 now, and that is the calculation of the goodwill or the bargain purchase gain. Now, in terms of the goodwill or bargain purchase gain, we need PC. There is no NCI in this case, and we need to compare this with the net assets, and we're going to get the goodwill as well. Now, PC is nothing but it is the investments in the balance sheet. So if you look at the investments in the balance sheet, it is appearing at 68 lakhs. And if you look at the net assets, I think it was 105. This was 105.7, which is without taking dividends. So this is 105.7 lakhs. And this is 68 lakhs. So this time we are not getting a goodwill, but we're getting a bargain purchase gain, which is nothing but a capital reserve. So 68 versus 105.7, that works out at 37.7 lakh is the amount of capital reserve. Okay, so now with this, we can go to the step number 5, calculating the other equity in the balance sheet. So we go to the step number 5, and we need now for the consolidated balance sheet, the other equity in this case. Okay, so the focus points need to be very clear in terms of how do you progress. Okay, I think Preeti, you said, sir, in exam, we should solve the questions according to steps as working notes. Yes. Can we draw a time scale in between the table for bifurcation of the other equity for understanding a proper bifurcation? Why not? Of course you can. Because at the end of the day, when you're making this time scale, you're creating a working note telling the examiner the status of what is pre-post. So I would advise do it because it throws a lot of clarity on your part to the examiner that you're very clear with the concepts as well. That's what is required. Okay, now coming to the aspect of the consolidated balance sheet, that is the other equity. Now the focus points. We need to consider the holding company's own other equity, and now we can say a minimum of 3 adjustments at the back of your mind. Next class, I'm also going to, make a little inputs on the 6 steps I've given you, adding a few points here and there, focus points, mind mapping in terms of things, if we get enough time. So in terms of this, we are going to take 3 adjustments, add the holding share in subsidiary post-acquisition profits. And you need to consider any stock reserve if there is downstream transaction, if any. You need to see if there is any downstream transaction. And now you also need to consider any dividends which the parent received from the subsidiary, because it was added to his retained earnings, but it is not an income from the group point of view. So you've got minimum of 3 adjustments in terms of step number 5. The share of holding in subsidiary post-acquisition, and this will be available in terms of the step number 2A. When you've done the analysis of equity, you'll get this from step number 2A. The stock reserve is something which you will get from the additional information, scrutinize, and you'll get the additional info. And even the dividends is what you're going to get from the additional info. So you need to be clear that in terms of the step 3 focus points, share of holding subsidiary post-acquisition, dividends received but not an income from the group point of view eliminated, and the stock reserve downstream, because upstream would have been taken in step number 2B. Okay, so let's consider now the columns. Now, in this particular case, we've got a couple of inputs in terms of this equity. You can say we've got at least 3 items in this case. We've got at least 3 items in this particular case. So let me tell you the focus points. This is like making an extract of the SOKI. So we can see that in the balance sheet, we've got other reserves. In the balance sheet, we've got other reserves, we've got retained earnings, and now we've also got a capital reserve as well, which is a part of the SOKI. The other equity is comprising of other reserves, retained earnings, and a capital reserve. So let's see the balance sheet of the parent. Other reserves is appearing at 48 lakhs. Retained earnings of the parent is appearing at 11.44 lakhs. And there is no own capital reserve. Now let's see the share in the post-acquisition earnings. In the post-acquisition earnings, we've already calculated it was 6.7 lakhs is the post-acquisition increase. So take this retained earnings increase 6.7, because 100% belongs to the parent. So the entire post-acquisition belongs to them. Then there is no stock reserves which are given, otherwise we would have eliminated from retained earnings. And of course, we have got dividends. 4 lakh dividend was paid by the subsidiary, which was credited to the retained earnings of the parent, and that needs to be eliminated because it's not an income from the group point of view. And we have done the calculations of the capital reserve, 37.7 as a part of the step number 4. So this capital reserve also will get added to the other equity in the balance sheet. So now let's have a look at the figures which are there. This is the step number 5. So that works out at 48 lakhs. This works out at 37.7 lakh. And this is going to be 11.44. Then it is plus 6.7 minus 4. That's 14.14 lakhs. Let's add up all these figures, and this works out at 99.84 lakhs is the sum total of the other equity. Wow, so this is done. Now with this, we can now make the consolidated balance sheet as well. So step number 5 is done, and now let's make the consolidated balance sheet. So you need to definitely 100% do these questions by hand, trust me. Okay, now let's go to the step number 6. So in terms of the step number 6, We're going to make the consolidated balance sheet, starting with the asset side. So we've got on the asset side the non-current assets. And now the focus points in terms of the 5 rules which we have done. So first of all, we've got on the non-current assets, there is PPE. And in terms of the PPE, we've got 2 items within this. There is land and building, and there is plant and machinery. So remember to consider the fair value adjustments as well. So when you go to consider, please remember to consider the fair value adjustments as well. So land and building is appearing at 30 lakhs for the parent, and it is supposed to be 36 lakh for the subsidiary, and the fair value changes, if any. And the fair value changes are there in the additional information. There was an appreciation of 20 lakhs. Same is the case for plant and machinery. It is appearing at 48 lakhs for the parent. And then it is 27 lakhs for the subsidiary. Then there is fair value changes 11.5 in the analysis, and there is additional depreciation as well. Careful. Land, there was a fair value increase, but no depreciation. But machinery, there is a fair value increase and additional depreciations as well. So that works out at 86 lakhs in the outer column. And this is 48 plus 27 plus 11. This is also coming to 86 lakhs. So this is as far as PPE is concerned. And then moving further, investments, of course, would not appear in the balance sheet, and there was no goodwill. So no goodwill is there. Then I am given the current assets. So in terms of the current assets, we've got inventory. So in terms of the current assets, we've got inventory, and that is 24 lakhs for the parent. And for the subsidiary, it is 7.28 lakhs. And let's see if there is any fair value adjustments as well. Inventory increased by 3 lakhs, so that is the fair value adjustments. So that works out at 34.28 lakhs is inventory. Then next item, we are given the financial assets. There is a trade receivable. The trade receivable is 11.96 lakh for the parent. And for the subsidiary, it is 8 lakh. No fair value changes. It comes to 19.96 lakhs. And then there is cash and cash equivalents. And this is 2.9 lakhs for the parent and 1.6 lakh for the subsidiary. That makes it a total of 4.5 lakhs. Right, so that's all on the asset side of the balance sheet. So this is 86 plus 86 and plus 34.28, 19.96 and 4.5. This is 230.74 lakhs is the total of the balance sheet. Wow. So now let's go on to the liabilities side as well. And on the liabilities, we've got equity and liability. And in terms of equity and liability, first of all, on the equity, we've got equity share capital. And the equity share capital only for the parent company, and that is 100 lakhs. And as far as other equity is concerned, you've already computed this in step number 5. Organize the data well in advance. So that is 99.84 lakhs. 99.84 lakhs, and least we forget, we've got NCI, though it is not there. But if there is an NCI, you need to present it as a last item on the equity component. Okay, so the equity is done. There are no non-current liabilities given in the question. Then in terms of the current liabilities, we've got a bank OD and a trades payable. So bank OD and a trades payable. So the bank OD is given to me. It is 16 lakhs for the parent, nothing for the subsidiary. And the trades payable is 9.42 lakhs for the parent And there is a figure for the subsidiary that is 3.48 lakhs. And there is a fair value change as well for a trade payable. Every time you're considering any asset and liability, you need to consider the fair value changes. Trade payable increased by 2 lakhs. So I think that's it. So this works out at 9.42 plus 5.48. It comes to 14.9 lakhs. So let's see if the balance sheet is agreed on this. And yes, it is agreed. Wow, 230.74 lakhs. So that is the total of the balance sheet. The balance sheet is agreed. Wow. I know this must have sounded quite, higher in level as compared to the case 1 and 2. I think the case 1 and 2 was pretty cakewalks, and this was a little better one question, but trust me, this is not a very technical question if you ask me. If you're doing it for the first time, yes, it can look like a technical question because there are a lot of things to be remembered, what is to be done where. But I would request and advise that please do this question by hand before the next class, because in the next class, we are going to do something similar questions within NCI. Get you the focus points very clear, because we're going to do some more questions with you in the next class on the consolidation aspect. Okay, let me see if there are any questions coming in. And okay, I think what it tells me, thank you. That's wonderful indeed. So over to you, friends, for any questions coming on your side. So we are done with the basics of the consolidations, and we'll be taking this further. But please do revise this. If the need be, you can look at the remaining part of the lecture, especially post break, and have a look at the nitty-gritties again in terms of the last portion which we did. This will give you a very good idea in terms of the focus points. The notes which I've given you, especially on the dividends, is of immense help, where you need to be very clear what are the focus areas to be kept as you move along the steps for dividends calculation. Thank you so much, Preeti. Thank you indeed. Thank you, all of you friends, on that. So I think that seems to be all coming in. Right, friends. So I think it's time to bid goodbye on that. So see you on the next class on Saturday. And please do revise all this. Thank you very much. Bye-bye and take care.